Good morning. It is Thursday, February 2nd here in New York City. This is Yahoo Finance Live. I'm Julie Hyman alongside Brad Smith here in the studio and Brian Sazi in the home office. We've got futures on the move following yesterday's Fed meeting, and we have big earnings to cover today, even more set to come out after the close of trading. Here are the three things you need to know this morning. According to Fed Chair Jerome Powell, the disinflationary process has started. Does this mean the Fed can complete its current rate hike cycle while also avoiding a severe downturn in the economy? We'll discuss.
Meta in focus this morning as shares are soaring pre-market following an earnings, really an impressive call by CEO Mark Zuckerberg, who is aiming to be more efficient in 2023.
That's right. And the NFL's big game is still a week away, but the tech earnings Super Bowl is here. We're going to tell you what to watch. And Apple's earnings, they're going to be in focus as well this afternoon, as well as a few other mega cap tech stocks. But first, let's take a deeper dive into what the Fed's comments meant for the markets yesterday here. And we'll give you a view of exactly what took place yesterday on the Dow Jones, and particularly putting on a chart view so you can actually see what took place there. We'll put it on a two-day view. And there you're seeing at about that 2 p.m. hour, the move that ensued immediately thereafter. The Nasdaq rallied going into the close, held on to a lot of those gains, and ultimately on the day closed up by 2%. And over the past 2 days in aggregate, that puts us higher by about 3.7%. You can see week to date, we are higher by about 2.6% right now. S&P 500, this was a kind of broad-based rally, but really led by some of those major tech names. So you saw that outsized move in tech. And then the Dow Jones Industrial Average, yeah, that closed higher. It was flat to the upside there. And in the futures this morning, we'll see exactly where some of that momentum may still be held onto. However, for the Dow futures right now, only up by about 0.1% here on the day. And then additionally, taking a look at the Nasdaq 100 futures, still seeing a lot of positive momentum there. That's up by about 2%. And then the S&P 500 futures, they are higher by about 1%. So let's set the scene with the action from the Fed yesterday and what it means for you.
At today's meeting, the committee raised the target range for the federal funds rate by 25 basis points, bringing the target range to 4.5 to 4.75%.
The Federal Reserve is raising its benchmark interest rate by 1/4 point, putting it in the range of 4.5 to 4.75%. The decision was widely expected by economists, and it's a step down from recent increases, since inflation is starting to slow and the Fed has decided it doesn't need to be as aggressive. But just because the Fed's tapping the brakes, that doesn't mean it has plans to pause rate increases anytime soon.
We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2%.
Today's announcement will have an impact on the U.S. economy and your bank account. First, the Federal Reserve's interest rate policy is tied to borrowing rates and made big waves in the housing market in 2022. Higher mortgage rates means higher monthly payments for people buying homes now. And since the central bank began lifting rates from its pandemic-era low, mortgage applications have seen a steep decline, plunging 40% in the last year. Second, you may have noticed you're earning more money in your savings account. That's because rising interest rates push up yields for savers, with some high-yield accounts now earning more than 3.5% annually. And last but not least is the Fed's ongoing battle against rising inflation. Chairman Powell reiterating the central bank will do everything in its power to fight rising costs, saying it won't stop until inflation is subdued. That'll be a relief if and when it works. In the meantime, the Fed's hikes are rippling their way through the economy and your wallet.
So that brings us to thing number one today, the disinflationary trend and what it means for markets. So can the Fed actually achieve a soft landing? Of course, we've said it time and time again, dual mandate for the Fed, maximum employment, but at the same time, price stability. They are prioritizing that price stability, even as we get a wave of employment data this week that actually seems to give them a little bit more actually cushion for their understanding right now, or at least their pathway forward right now, Saz.
Yeah, I do want to point out, though, I know the market, it was really enthused. We saw that reversal as that press conference by Jay Powell took hold. I just want to remind investors out there that this doesn't mean that we're seeing deflation. That is not the same as disinflation. That's the first thing. Next thing, I don't think the Fed chair said or pivoted to that we are getting rate cuts at some point this year. What he essentially said, they may not be raising rates anymore past that March meeting. So that's a good thing as well. And also, let's keep in mind, we're focusing on what this all means to people's money, is that rates are still going to be high. There's likely another rate hike coming. And this is still a Fed that is trying to slow the economy down. What does that mean? It will cost more still to buy a car, to buy a home, and to do a lot of projects around the house that you might have planned for. So again, this isn't a Fed cutting rates. It's just the Fed maybe being a little less hawkish and the stocks embracing that.
Yeah, I mean, trying to boil down a very complex issue and all of the ripple effects that a Fed rate increase has. But just to further explain on what we're talking about, there's inflation, there's deflation, and there's disinflation, right? Inflation is when prices are going up. Mm-hmm. Deflation is when prices are going down. Disinflation is when prices are going up at a slower pace. So say if year-over-year inflation goes from 6% to 2%, right. That is disinflation, and that is what the Federal Reserve wants to have happen. So essentially what Fed Chair Jay Powell was doing was acknowledging that, yes, there is some disinflation, whether it's directly because the Fed is raising rates, and that's having an effect, or also because of the supply chain effects have been abating, right? So, yes, maybe your car is more expensive, although some of the car prices have been coming down, as we well know, Sa. So it doesn't mean that you're going to be paying more for everything. It means things are going to be more spotty this year. And then, of course, there are the implications for the market, which is a whole other ball of wax, right? And now, certainly we see, and we certainly saw in the reaction yesterday that you were pointing out, Brad, that investors are now looking beyond this interest rate increase cycle to the end. Maybe they're a little bit more hopeful that there's not going to be an outright recession and maybe not a severe one. And that's where some of this optimism is all coming from.
And perhaps on the mindset of the consumer, too, they might be thinking about where wages may stay elevated in order to offset some of the price inflation that they've already incurred right now, too. We saw that in the ADP data, and then additionally thinking out to the jobs report data. Keep a close eye on the wage growth figure that we've continued to bring to your attention here. And within the most recent report, 4.6%, but continuing to think about where you're seeing some of that job migration and post kind of the Great Resignation era, now looking at some of the layoffs that have come forward, some of the hiring freezes that have been initiated for employees that are, or prospective employees that are still looking for jobs. There's still a multiple of roughly 2 for them to figure out what kind of job they want in the economy, and then ultimately still be able to make sure that their wages that they're taking in are elevated and offsetting the pace of inflation that they had seen, and then the disinflation as well, perhaps, that they're expecting to continue at this point.
All right, well, let's stay on that theme of layoffs and lock in on tech. Meta in focus this morning as shares are soaring pre-market. Also, the top ticker on the Yahoo Finance platform. That is after an impressive earnings call by CEO Mark Zuckerberg, who is aiming to be more efficient this year. Take a listen.
2022 was a challenging year, but I think we ended it having made good progress on our main priorities and setting ourselves up to deliver better results this year, as long as we keep pushing on efficiency.
All right, joining us now to break it all down is Tom Champion, Piper Sandler Director and Senior Research Analyst. Tom, good to see you here this morning. So you have, I think, Zuck having a come-to-Jesus moment in terms of expense cuts. You have a Fed that may be not raising rates next year. Are you getting an ultimate buy signal here on Meta shares?
Yeah, absolutely. I think this quarter was a real sea change from what we heard, say, last quarter. And it was a terrifically disappointing earnings report last quarter. But they've taken tough actions. They've laid off 13% of the workforce, and they're reducing spend on the office footprint and making other changes and being much more mindful on CapEx spend as well. So it's a big change for this company, and it's resulting in a much more favorable outlook for free cash flow.
How much of this is narrative from Mark Zuckerberg? And I ask that because, he's talking about things like, all right, we're going to cut back on some of the metaverse spending. Of course, they had ramped that so early on. They're going to boost their reliance on AI to really drive some operational efficiencies as well. And so in this year of efficiency that he's laid forth, how much of that is true in terms of it being something that they're saying versus something that in action is long-term sustainable and going to trickle down to margins?
Well, there's a narrative element to how they're talking about the products. There's no question. They're saying that AI technology is helping them boost conversion of the ad product by 20%. There is a narrative element about how they are continuing to manage IDFA and the Apple ATT headwinds. But after the quarter, we're left with a GAAP OPEX outlook for 2023 that it's $5 billion lower than we were given in November following the 8K that announced the headcount reduction. That's real. That's significant. That's not a narrative change. That is what's now embedded in expectations, and that's a far larger improvement than we thought was likely going into the print. There's a similar reduction to CapEx. So you're right. It is a narrative change, and talking about things like the year of efficiency is a little less maybe grand or ambitious than talking about the next computing platform in the metaverse. But it's having a palpable impact to street estimates, and we can see that in the stock.
Tom, is Meta still spending too much on the metaverse?
Yes, I would argue that's the case. I think the payoff on the metaverse is likely quite a ways away. And so the investment that it's kind of measured in like, $10+ billion, in our view, seems outsized. But, who are we to say how Mark Zuckerberg should run his company? He's, an icon and a great, entrepreneur. So this is his judgment call.
Well, we're the shareholders in theory.
Yes, well, so is he, and it is one part of the equation, and he is certainly addressing the cost structure in the core business and making some very, very difficult decisions. So we certainly applaud him for that.
Tom, as someone that covers tech more broadly, are you more inclined to get more bullish on your coverage universe, like a Meta, like the other names you cover, because the Fed may not be raising rates by the middle of this year?
Yes, I think that is a factor, right? The Fed rate cycle has introduced a tremendous amount of uncertainty, and it impacts our view of the discount rate. So the sooner we get to the conclusion of the interest rate hike cycle, the better for tech stocks, no question.
Yeah, most definitely. And that's obviously reflected in some of the action that we saw in these stocks yesterday. Tom, thanks so much. Really appreciate your time this morning. Tom Champion is Piper Sandler Director and Senior Analyst talking to us about Meta. Lastly, the third thing to know this morning, the tech earnings Super Bowl. Meta is just the beginning. Apple, one of the names headlining today's reports after the close of trading. Let's take a dive into what you should be watching for from the tech giant today. And let's start with services revenue. That's one of the things I'm watching. We'll get to product in just a moment. But services has definitely been comprising a higher amount of the overall numbers from Apple, and that's something I know that analysts are going to be watching for as well. $20.47 billion is the estimate for services, and that's something that the company is also guided to, right, and emphasized that it wants people to really be watching. So that's the number that I'm going to be watching from Apple.
No, Julie, that's a good call out, too, because as the economy has slowed, now it is generally universally seen that these services sales from Apple are recurring revenue stream, and they will be recurring no matter what the economy is. So I think that's a very important thing to be watching, to see if consumers are cutting back on some of those Apple services.
Sal, one thing that I'm going to be watching, and we're going to be discussing this later on, but iPhone revenue here. iPhone revenue is expected to come in about $68.3 billion. And there's kind of three ways that I would look at this. And one of them is how their shipments are really lining up. Of course, that's not a figure that Apple themselves that they put out there, but it is one that is largely monitored, and where those global shipments are going, you can monitor this through IDC. They have a good kind of shipment tracker on Apple iPhone shipments, and then as well, just where regionally they're seeing pickup. Because if we think about 2023 and the outlook that the IMF put out there and where the biggest growth on a GDP basis might come forward, it is India and it is China. And for China, that's a big part of Apple's business. In fact, they're expected to bring in about 23, my figure is on a different piece of paper, but about a little more than $20 billion in this quarter. So that is something to also keep an eye on there.
21.8, I think is what I see, yes.
Yes, perfect. So $21.8 billion in China, Greater China. And then just the demand cycle is what I'm hoping to hear a little bit more on from Apple, where we fall within this kind of range of super cycles that they've touted in the past.
As for me, guys, Meta's new $40 billion stock repurchase program, they uncorked last night. That brings their total authorization to $50 billion. That inspired me for Apple here. I'm watching Apple's cash levels. Now, the prior quarter that Apple reported, they exited that quarter, let's say, with about $50 billion in cash. And cash is very important overall for any company. But as it pertains to Apple, I want to know the levels they ended this quarter with, because for that April quarter is when Apple usually comes out and lifts its dividend and it uncorks a giant share repurchase program of its own. Keep in mind, last April, Apple came out with a $90 billion stock buyback plan. So I'm curious on what these cash levels are, because I think will offer a great indication on how much stock Apple might be buying back, or might tease they might buy back come April.
Yeah, this also kind of brings the mind back to late 2018, the final quarter of 2018, when you saw some of the tech companies and their share prices declining so rapidly. What did many of them do? They had this kind of buyback backstop, if you will, where they were looking at their share prices and saying, okay, this is an attractive level for us to buy in. Shareholders praising that perhaps buoying them just a little bit going into the next year.
Yeah, I wonder politically, how, for Apple, which kind of stands alone, that's one thing. But I do wonder, yes, Meta did it too, but I do wonder how widespread that's going to be when they're slashing costs, right? On the flip side, if they're buying back stock. We'll see what happens with that.
Absolutely. Well, we're going to discuss Apple's earnings after the earnings call. Tune in. Sazi and I are going to break down exactly what Tim Cook says, the man from Mobile, Alabama, what he has to say on this earnings call for the quarter after the call. That's today. Yes, after Apple's earnings call. Coming up, everyone, that word that made stocks fall in love with the Fed. We're going to break down today's morning brief next.
We continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time.
The Fed chair making it clear tightening isn't over just yet. So let's call it a slightly dovish lean that gave investors a boost yesterday after comments that the disinflationary process has started. According to Yahoo Finance's Miles Udland, disinflation was the word that made stocks fall in love with the Fed chair. He writes in today's morning brief that to take the importance of Powell's comments a step further, disinflation suggests the Fed may well be able to complete its current interest rate hiking cycle and avoid a severe downturn in the economy here. And within this morning brief, I think it's, of course, something that we were breaking down earlier with regard to the stock reaction, believing that disinflationary itself was the green light, the signal to say, okay, you know what? Risk that might be a little bit more appetizing at this point.
You know, I think also that because the expectations going into the Fed chair's comments, you know, we talked about this yesterday. We had this big rally in risk assets in January. The last time we had a rally in risk assets going into a Fed meeting, the Fed chair came out and smacked that down. He did not want to see a loosening in financial conditions. He was directly asked several times if he was disturbed by the rally that we'd seen in risk assets, and he didn't really seem to react to that. So disinflation definitely part of it, and definitely relief versus expectations, I think, Saz.
Well, look, we're going to get a lot of Fed members out there on the speaking circuit there coming in the coming weeks. I'm very curious if they walk back some of those comments that Fed Chief Jerome Powell said yesterday that the market really embraced and perhaps was too enthusiastic and too quick to embrace all of it. So is this the shift for the markets that we should be waiting for, or should we dial back the euphoria? Let's ask Tony Dwyer, Canaccord Genuity Chief Market Strategist. Tony, thanks for taking the time here today. We'll put that question to you. Disinflationary, is that the shift or the pivot in tone, at least, that the markets were looking for?
Well, it's what is supposed to happen when you have economic weakness and you start to see a drop in activity and especially final demand. You're supposed to have disinflation. So, you know, our view has been that inflation isn't the issue it's actually been this way for the last few months. Inflation's not the issue. It's going to ultimately be economic activity and the unemployment rate. So, you know, each comment that he makes is taken, you know, as gospel. But as you know, it's pretty volatile around whether it's right or wrong.
And Tony, in your note, I love your analogies. We love analogies in general in strategist notes. This morning, you counseled patience in your reaction to the Fed. You talked about a slow cooker pot roast as the way to go. Talk to us about what you meant.
Julie, as you know, for all these years that we've talked to each other, I think I get more stuff out of my headlines than I do my data. But anyway, you know, every single word, like disinflation is the word today. And clearly that is showing some strength in the market. The market has already been very strong coming off of that, the low for a lot of the mega cap tech stocks. But we're taking it, it's like trying to eat a pot roast out of a microwave. Do you want to eat it out of a microwave or do you want to eat it out of a slow cooker? Guys, this is what is supposed to happen. I think I probably underestimated the positive effect of this transition from solid growth to negative growth. It would be historically unique given where the Conference Board leading economic indicators are, where the yield curves are, to not have a recession. So I think what I underestimated was the positive influence that would have in an oversold tech sector and some of the mega cap stocks. But ultimately, we're in this transition where the pendulum is swinging, and right now it's in the sweet spot. The call that the market is making is that it won't go to the more difficult position of potentially negative economic growth. For example, Julie, I can't remember, I've been doing this about 35, 36 years. I can't remember when cost cutting was the new buy signal. Right.
Yeah,
so you look at some
unusual.
of these, you look at some of the companies that are out there, and it's all about maintaining margins. And that typically happens when you have a weakening in demand. So in our view, right now, for the viewers, the fundamental side, I think, limits your upside because you have the potential for this recession. And the downside is probably protected by just the sheer momentum that we have. Ultimately, it's going to come down to the slow cooker, the unemployment rate, and when that defines if or when the recession is going to begin.
Saz?
Tony, I would eat a pot roast out of a microwave. I'm just saying.
You can have at it.
Well,
I'd rather have it out of the slow code.
Fair enough. But look, what we heard, anything you heard from Powell yesterday, to you, would that suggest rate cuts of any kind, even one, are in the cards this year?
So, Brian, our base case has been that they're going to get aggressive by the end of the year. So we had thought that we had continued to think that the market goes back to the October lows in the first half on the back of a recession, but it gets nasty enough where the Fed starts to more aggressively cut rates than the market is anticipating. And maybe that's getting pulled forward to some degree. But to me, the bull scenario is not a soft landing. For example, today, when you have the continuing claims and initial unemployment claims, again, at near the best levels of the cycle, that's not suggestive of a labor market, which is what Powell's focused on, that is easing. So what if we get this period? If you get a soft landing, you still have an elevated inflation rate, and that keeps the Fed higher for longer. In a leveraged system, what you need is a steepening of the yield curve because rates are coming down more aggressively, and that allows you to look through the coming economic weakness. So to me, the soft landing scenario isn't the bull story. It's a much more aggressive, it's a decline in economic activity that brings about more aggressive rate cuts.
Always top analysis for us. Tony Dwyer, Canaccord Genuity, Chief Market Strategist. We'll talk to you soon.
Have a great day, guys.
You too. All right, straight ahead, the earnings parade continues. We'll break down numbers out of cosmetics play e.l.f. and Stanley Black & Decker next.
We're just about a minute away from the opening bell on Wall Street on this day after the Fed, and still folks kind of digesting the commentary that we got from Jay Powell and company. You see there Nasdaq leading the way up in terms of the futures here. Not surprising, since that's been the index that's been the most sensitive to perceptions and changes in interest rates. It's up, indicating a gain of 2% of the open S&P futures, pointing to a gain of 1%. The Dow moving much, much less. It's just up 0.1% in terms of the futures here this morning, guys. So obviously, Brad, we are watching the Fed reaction and we're watching earnings as well, and people bracing themselves for after the bell earnings.
Yeah, absolutely. I mean, you got some big players out there, Apple, Alphabet, Amazon, all of those coming fast and furious. And you got, of course, the likes of Ford and Qualcomm, huge companies coming after the bell today.
Yes, so we could see a lot more volatility in the picture here for sure. If you take a look at the opening bell here this morning, though, right now we have enthusiasm. See BlackRock ringing the opening bell. You've got that enthusiasm, and perhaps investors are heartened by Meta and maybe not bracing themselves so much for AAA after the bell, but more so now encouraged, looking ahead, looking forward to those numbers, and maybe hoping that they will not be as bad as maybe some of the earlier forecasts had warranted. We'll see what kind of pullback or not in consumer spending in particular is reflected in those three companies. So going to be really interesting here. Brad, I know you guys are going to be talking about it after the bell, but in the meantime, we got a pretty big open here this morning.
Yeah, we do. Well, the Dow flat just barely to the upside. That big open coming in the form of the Nasdaq Composite. Take a look at that last 3-day aggregate move. It's now higher by 6% this week, and we'll see exactly what the rest of today nets out for us here. But strong move in the tech-heavy average. S&P 500 up more than 1% at the open, and the Dow, that's just going to keep waffling here, it seems, out of the gate. So we'll see if that can find some conviction one way or the other. But taking a look at some of the S&P 500 sectors as we begin the day this morning. 11 sectors, we got them all pulled up on screen here for you. You've got communication services leading the charge here intraday. My goodness, had to check my glasses there for a moment. It is higher by about 5%.
Meta, it's all about Meta.
All about Meta, seriously, yeah. And so communication services, let's take a look at those past 4 days as well here, just to kind of put that spike in perspective here on the day. Up 5% out of the gate, leading the charge. You've got consumer discretionary and technology also higher here. Consumer discretionary up by about 2.25%. Bringing up the caboose, yeah, XLP, my gosh, consumer staples down by about 0.9%. We'll see if that can get right a little bit later on, Saz.
Yeah, exactly. All right, for me, I'm tracking Stanley Black & Decker here from the home office, guys. A couple things stood out to me here. Of course, the company beat on earnings, stock getting a little bit of pop here, but I want to call out two things. First, is them teasing a new $1 billion cost-cutting program. I used to cover Stanley Black & Decker as an analyst, and the one thing that always amazed me with this company is how efficient they are, and seemingly on the drop of a dime, they can come out with these major cost-cutting initiatives to boost margins. They just seemingly do this every single quarter, and oh yeah, they actually execute and over time do improve their margins. So that was something worth calling out here. Now, on the negative side, they are noting that overall organic sales dropped 5% in their tools and outdoor segment. They're citing weakness in lower consumer demand in the do-it-yourself market. Now that dovetails, guys, what we heard about a week ago from Sherwin-Williams. Not a great quarter from them, not a great outlook. Immediately, I'm thinking Home Depot and Lowe's are sitting on disappointing quarters. Both those quarters just ended earlier this week for those two companies, and then maybe even the likes of a Traeger, another company that sells into the home centers. Maybe not a good quarter from them overall. We've been talking about the impact of rates all morning long. When you look at Stanley Black & Decker, I think that says a lot. Continued pressure, continued downturn in the housing market, of course, that gained steam late last year, impacting a company like this that sells tools that you need to build a home or repair what you got.
Yeah, it seems like they were still passing through some price increases during that quarter as well. They noted that within the segment for tools and outdoor, as you were running through a moment ago. And regionally, Europe, that was down 3% during the quarter. North America down 7% during the quarter as well. So really kind of going back to that consumer mindset that you were mentioning a moment ago, Saz, and where some of the DIY projects. I mean, if you got tools, perhaps you don't need more tools to just continue to.
You always need more tools. Maybe not now.
I mean, bottom line, guys, it's surprising to see these shares up. They were trading lower in pre-market trading. The forecast is pretty terrible, right? And yet the shares are trading higher. And I think this goes back to what we just heard from Tony Dwyer, that companies that are cutting costs are being rewarded, even if the numbers don't look that great right now. I mean, that's reflected, I think, in Meta to some extent, too. We're seeing a lot of examples of that, and Stanley Black & Decker is just one of them.
Yeah, if there's any continuation in that industrial kind of decline that they saw, net sales down 1%, then that could certainly impact the margins even more so from here as well.
Yeah. Speaking of industrials, let's talk about Honeywell. The company missed analyst revenue estimates in the fourth quarter. Increased commercial aviation sales partially offset by lower defense volumes year over year. Those shares are down by about 3%. So that going more in line with what one would have expected here. And if you look across their different categories here, aerospace was indeed strong. There saw sales rise by about 11%. But if you look at some of their other units, safety and productivity solution sales down about 8%. So definitely sometimes it helps to be a diversified industrial, and sometimes you get dragged down by some of the segments that underperform.
Yeah, the CEO had said that late cycle aerospace and energy, particularly those markets, well positioned for a strong growth year in 2023. And then additionally, when you look at some of the full quarter or the fourth quarter and full year 2022, this was just a challenging operating environment for Honeywell. Given the diversification that they do have, this is a business that would also look to kind of lean into one segment versus another when you did see any type of rattling within one particular segment or try to kind of back end that for another. But their Honeywell Building Technologies, those sales were up by about 15% on an organic basis for the quarter. So that one of the major call outs that they have pointed to as well.
Yeah, this was really an aviation quarter, as Julie teased right there. The commercial original equipment part of that aviation business up about 25%, and the aftermarket up 20%. And this really fits nicely what we heard from GE when they reported earnings a couple weeks ago. It was an aviation-led quarter from them. Boeing's quarter not that great, but still a little bit of a comeback quarter from them. And aviation, at least right now, guys, looks like we are doing pretty well given sluggish growth in Europe, sluggish growth in China, and of course sluggish growth here in the U.S.
All right, we're taking a look at shares there on the day. They're down by about 3.25%. We also want to take a look at the stock performance this morning of shares of ELF Beauty. Following a glowing quarter, sparkling quarter, if you will. There's so many ways to classify it, but they topped estimates on the top and bottom line. The cosmetics company growing net sales by 49%. That was primarily driven by strength in both its retailer and e-commerce channel. So really flossing the gloss here, not just with the net sales growth, but additionally with the market share gains. They gained about 150 basis points of market share, the company had talked about, and particularly this was one of their biggest net sales growth quarters in I believe the last 4 years. And so it does kind of beg the question of, all right, what were the comps that they were going up against? But again, at the same time, where some of those little luxuries might be being leaned into, especially within those wholesale partners that ELF does have.
No, I think this solidifies probably a good quarter from Ulta when it reports here in a couple weeks. This is a very good quarter by ELF, or ALF as I like to call it. And it comes despite them raising prices. Now, despite those price hikes, their products are still seen as very affordable. The product assortment is very broad, so they have been gaining share in this market. And it is interesting to see this. You take this report, a very value-focused cosmetics play. You saw McDonald's earnings earlier in the week blow everyone away. And you just get the sense that there is some trade down happening. I know the market's very excited about these potential this stop in rates, but a lot of consumers out there are really struggling and are looking for ways to save money. And I think you're seeing that through the prism of these ELF results, and you saw them in the prism of McDonald's, and you probably see it, I would suspect, even the dollar stores when they report in a couple weeks.
I mean, maybe they're trading down in terms of brand, but it sounds like, from looking at some of the analyst commentary, that they're actually buying the upper end of the ELF products. Now, is that still cheaper than a more premium brand? Probably, but if they're trading down in brand, they're still allowing themselves some latitude, I guess, within the brand here. So that seems to be helping matters.
It is cheaper. A lot of these products, Julie, sell between $5 and $15.
Right.
I mean, you go to Ulta. I mean, you could drop $100, $200 a pop in here for some of their cosmetics. So ELF is really seen as the price leader, and with a big presence in Walmart too, which of course is the value king. Yeah,
a lot of people adding a little bit more ELF on the shelf, or at least the bathroom shelf during the quarter, and that directly trickling through to some of the gross margin. And this comes back to your point, Julie, of where within that product mix they may have been purchasing. The gross margin, that increased by about 255 basis points, 67%. But again, price increases, cost savings, product mix, and then the inventory adjustments, they said that kind of offset some of that gross margin growth.
One more pun.
One more?
Olivia Tong over at Raymond James called the results flawless.
Flawless. I wake up like this.
Yeah, exactly.
Flawless. Guys, coming up, Bitcoin getting a boost from Jay Powell's press conference. Yahoo Finance's Jared Blickery going to break down the latest market movers at the open next. Welcome back to Yahoo Finance Live. Taking a look at the major averages this morning. We had some green on the screen as we kicked off today's activity. Let's get on over to Jared Blickery at the Wi-Fi Interactive for more on today's early activity. Jared.
Yes, Nasdaq is leading, Dow is in the red, and guess what? That is a story of the year. Nasdaq up over 2%, and we're going to dive into some of those and see what the constituents are doing in a second. But first, I want to show you on a 3-month basis, the S&P 500 has broken to the upside quite convincingly. Yesterday was a nice close above these highs from earlier in the year and late last year as well. And you take a look at the Nasdaq has really been what's on fire this year, and you can see this huge gap up here. And then here's the Dow. Dow is just kind of in a trading range here, but I'm going to show you a 3-year chart. Let me get this down to a 2-year. It's only about 8% off of its record highs, and you compare that to the Nasdaq. Nasdaq still has a lot more work to do, so we'll see how that plays out today. And also want to take a look at the bond market because we are seeing yields heading down to levels that we haven't seen since about 6 months ago. Here's a 10-year. That's dropping. That's going in the right direction for tech stocks. 5-year is also broken to about 6 months lows, and also the 30-year, checking in on that. Very similar story, but checking in on the lows, or basically testing the lows from late last year. And here's the US dollar index. That was making a new relative low. It's climbing higher now off of that ECB decision. Don't have time to get into that. But in terms of currency movements overall, things have been favoring the dollar. XLC, don't see that often. I agree with you, Brad. Got to do a double take here, but that's all Meta and Alphabet kind of piggybacking off of Meta on those earnings. Then we got consumer discretionary, tech, and real estate. Those are the 4 big outperformers. And I want to take a look at crypto here. There we go. Here's Bitcoin, up 3% today. And if we take a look at the last 2 days price action, you can see big outsized reaction here with respect to the Fed. And as I've been saying for a few months, Bitcoin has really been leading. It's been the high beta reactor to these FOMC announcements. So you want to see what's moving? Well, check out Bitcoin, and everything else is probably moving a little bit less, but in the same direction. I want to show you one more thing before we go here. This is Bitcoin and how it's reacting to Fed decision. You can see until the Fed actually conducts their announcement, that is from the open till 2 p.m., it has been trending up. Fed day from 2 p.m. to 4 p.m., we saw it tick up yesterday. That has been trending up, but post-Fed day, for the most part, since last year, has been trending down. Guess what? That's today, so a little bit of negative seasonality. We'll see how that plays out with Bitcoin today, guys.
Indeed, we will. And we'll be talking more about Bitcoin probably with Kathy Wood later on in the show. Jared Blickery, thanks so much. Appreciate it. All right, here's our stat of the day here, folks. Peloton shares surged 20% on its earnings day on Wednesday, despite another quarter of large losses in free cash outflow. It's worth it for the bulls to keep this in mind on Peloton. Over the last 4 quarters, Peloton has lost a shocking $639 million on an adjusted operating basis. The operating losses reflect the company's still bloated cost structure and pricing pressure on its various products. Coming up, as new dovish comments from the Fed cement the bottom for stocks, we'll dive into the market's technicals with longtime technical strategist Luis Yamada. We'll be right back.
Brian Sosby here with Brad Smith, and we're getting ready for our After the Call on Apple earnings, which hit on Thursday after the close. One big number I'm watching is the stock price. Apple stock is up 11% year to date on a lot of hope and optimism. Brad, what you watching?
I'm watching services. I'm watching where those iPhone shipments are actually netting out. So keep a close eye on everything between those products and services, but specifically on that iPhone because it makes up the lion's share of that Apple revenue base.
Are you excited to hear Tim Cook's voice?
Always.
Always.
It's so soothing.
It really is. Me
It's
too.
like butter on a croissant.
That is a perfect way to put it. All right, after the call, Yahoo Finance, check it out on our homepage. We'll be live right after that Apple earnings call ends, a little after 6 o'clock. We'll also be live on YouTube. Watch it, bookmark it, you name it.
10-year yields are falling this morning as traders look to the end of interest rate increases. But our next guest says the yield trend is actually higher. If you consult the charts, that's what she does. LY Advisors Managing Director Luis Yamada joins us right now. Luis, what a pleasure to see you. It has been a while, but I thought it was important to talk to you right now because of what you're seeing in terms of the charts here. And, you know, as I said, people are now looking to when the Fed is going to pause. What are the charts telling you about what's going to happen with yields?
The charts are telling us very distinctly that the 40-year trend of falling rates has come to an end. I sent you one chart, which you may have there, showing the downtrend from the 1981 yield peak having been broken in December. And that's a pretty definitive break, 40 years. Says a lot in technical analysis. But the other interesting point is that the MACD, or the momentum indicator, on a monthly basis, there it is, you can see it now, the break in the price of the yield at the top of the chart, and the bottom of the chart is the momentum indicator, the MACD. And for 40 years, it remained flat until December, when it broke out through that resistance level. These are major technical statements. The bigger the base, the higher in space. Historically, interest rate cycles have run from 22 to 37 years. This one, probably due to the pandemic disaster, ran 40 years. So we've set another record in terms of how long this interest rate cycle has lasted. And we think that we are seeing a definitive turn toward higher rates. That doesn't mean the Fed can't pause. It doesn't mean rates can't pull back 10-year toward 2.5%. But the point is, with these advances and pullbacks is characteristic of a new uptrending cycle. So as long as we don't put in a new low, we think that this cycle for rising rates has just begun. And historically, it was very interesting. The last cycle, I don't know if you're able to pull up the second chart, which really is reversed into the price of the bond. So you see the current cycle on the right, but flipping rates so that it represents price. And notice again there on the upper right, the break of the uptrend. And on the left-hand side, you see the last rising rate cycle from 1946 to 1981. And each time you had back up in rates, you had back up in price, a decline in rates at each of those green circles or arcs, if you will, but you never had a chance to get in again and make money in terms of the price of the bond. So I think this is the time to be cautious. It's giving older people a little bit of interest for a change. And I think especially for the younger traders, they have to know where they are in the long-term cycle.
So just to synthesize the charts, which you've so brilliantly compiled for us here, Louise, you would say that this and what we're seeing right now in the environment are kind of emitting some sell signals? Or
you
caution?
Mean very short term? No, on a long term basis, we are now in the new rising rate cycle from my technical evaluation that could last decades. And actually, if you look at the second chart, I don't know if you have it there, basically, we're okay in terms of the market if it wants to go higher, but I think Powell was right. Growth perhaps continues in certain stocks, but it may be slower. And the other thing is we should wait until.
Louise, do we have you?
Oh, it sounds like we have lost Louise's signal, unfortunately. But what she was saying was so interesting because it's obviously so counter to the sort of conventional wisdom here, or what we have been seeing play out in the markets. That said, I think we have Louise back there. Louise, we have you?
I'm sorry. Where did you lose me?
We lost you at the end. I think only at the end of what you were saying. I do know that Brian Sozzi wanted to get in here and ask you,
Louise,
and switch gears a little bit, if you don't mind.
Yeah, big fan, long time admirer of your work, Louise. A lot of investors on our platform are trying to make sense of this move in Meta shares. Do you think just what we heard from them last night fundamentally sets the stock up
you're skipping right to Meta? Well, technically, the bigger the top, the bigger the drop. The bigger the drop, the longer the need for repair. You've had a little bit of a turn here off the low from December. Generally, you need a little bit more backing and filling. And if you look at the chart from a monthly perspective, you get into the 180, 200 level, you're running up into resistance, quite a bit of it. So some people may decide that they'd like to get out or take less of a loss or take a quick profit. I'm not sure that I would consider the stock running back to new highs anytime soon, but you could have a further rally. Obviously, there's a lot of hype over it at the moment.
Indeed, there is. We'll see if it lasts. Great to see you, Louise. Always nice to catch up, and we should do it more often. LY Advisors Managing Director Louise Yamada, thank you.
Sorry for the pauses.
This is part of our new world,
New
Louise.
environment.
Don't
Julie,
worry about
thank
it.
you so much.
Thanks.
Appreciate
Take care. Coming up next, we're going to do a quick check on some market movers to close out the hour. Stay with us. Let's take a little oil detour, shall we? We are seeing oil prices pull back today, a little more than 1% as we've got a stronger dollar. That's one of the things that could be weighing on it. WTI at around $75 a barrel. Brent just about 81.68. But we're also watching, of course, the energy stocks, and that's because we still have many of these oil majors that are reporting their numbers. Let's start with ConocoPhillips, continuing on the trend that we have seen from some of their peers and returning cash to shareholders. In the case of Conoco, an $11 billion buyback is what it is authorizing for 2023, and it's also declaring a dividend of 51 cents a share. But as you see, the shares are down by almost 5% here. It looks like the company's fourth quarter results are coming in below what analysts had been anticipating, so that has to do partly to do with what we are seeing here. For the forecast, the company's CapEx is higher than had been estimated, so maybe there's a little bit of disappointment that they are spending more, perhaps. And then there is Shell, which we also heard from Royal Dutch Shell, and it becoming the latest oil major to report a record profit for last year. For last year, Shell made $41.6 billion in profit. That means now that we've got Chevron Exxon, and Shell. A total profit from those three companies of $132 billion. Big record profits from the oil majors. Those shares, though, are trading little changed in today's session. If we do look at the sort of heat map that we have of earnings overall and how these companies are trading today, looks like a little bit of a mixed picture. Obviously, Meta, the big one in the green here, but we have got Merck and Eli Lilly trading lower. We're going to talk more about those later, as well as Bristol Myers Squibb. So pharma, a little bit weaker in today's session. Coming up, we'll have a conversation with ARK Invest founder Cathie Wood talking about AI, her views on the Fed, and much more. Stay tuned.
All right, welcome back to Yahoo Finance. It's Thursday, February 2nd. I'm Brian Sozzi alongside Brad Smith and Julie Hyman. Markets today, they're a little mixed. This after the Fed raised rates again by 0.25 percentage point, but sounded more dovish than investors planned for. That is fueling gains, at least in the Nasdaq, though, which is leading the way, as you've seen on the screen, almost up 2% here in the early going. Now, here's what we're watching for this hour. All aboard the ARK. Cathie Wood joins us shortly to talk about her big investment ideas and why the Fed should rethink its rate hikes. And a hot quarter for Chili's parent, Brinker International's CEO Kevin Hochman joins us to break it all down. And Harley-Davidson revving up its profits as the motorcycle maker releases upbeat earnings we discuss later this hour. Julie, over to you.
Yeah, let's expand on today's top story. The Federal Reserve raising rates yesterday and giving clear signals that there's at least one more hike in store. But while investors are taking heart in that less hawkish Fed, some investors think the Fed is not pulling back far enough or fast enough. Joining us with more is Cathie Wood, ARK Invest founder and CEO. Cathie, great to see you here this morning. This is something you've been talking about for a while, right? That you thought we would actually see not just disinflation, but some deflationary pressures in the market, and that the Fed should slow down. What did you think of what we heard from Jay Powell yesterday?
Yes, hi, Julie. Yes, I think the most important thing he said was that he agreed with Lyle Brainerd, who's saying we are not in the middle of a wage price spiral. And that's code word, I think, for saying we are not in a 70s style inflation, which was the biggest risk that he was pointing to. And I would also say that Larry Summers, who seemed to be apoplectic earlier or last year, mid last year, I would say, saying this is a 70s style inflation and you've got to take interest rates up to 6 or 7% or higher on the Fed funds rate. He has changed his tune. He was saying, whoa, 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 maybe you shouldn't indicate anything about where interest rates are going. So big change in tune there. And I think also a big change in tune from Treasury Secretary Janet Yellen as well, who I think last week said something like, I think once we're through this inflation, and it seems like she wasn't using the word transitory again, but it sounded like it. She's saying when we get through this, we're probably going to be grappling with a very low inflation, slow growth environment. So big changes in tunes from the advisors to the Fed. And yet they voted unanimously to increase 25 basis points. And when I wrote my open letter to the Fed, it was really about that. You can't be unanimous in this call. There are too many conflicting indicators, but they are, nonetheless, they are changing their tone.
So with the absence of Fed Chair Jay Powell, and this is Brad, by the way, with the absence of Fed Chair Jay Powell saying anything during the month of January and the meeting really kicking off at the tail end, and of course the announcement to begin February, during the month of January, ARKK, your fund in the holdings, it had a great move to the upside. It was up by about 37%. And so within that, and that January performance, do you believe that this is kind of the making of a bear market rally that we had seen during January? Or do you believe that with the comments from the Fed, that there's actually more steam ahead, more full steam ahead for some of those more risky assets out there?
Yes, Brad. Well, I'm struck that the market is now leading the Fed. And when I say the market, I'm really talking about the bond market. So the 10-year bond yield peaked in October at about 4.3%, and is now down this morning, I think, to 3.35%. So huge rally in bonds. And effectively, the bond market is saying, we don't have an inflation problem, and the Fed is probably close to the end of this move. Last year, we did have, as you call them, bear market rallies, and they were pretty powerful a few times during the year. And then after those bear market rallies, we had Fed Chairman Powell come out and really slam expectations by saying, we are going up 75 basis points at a time. We don't have inflation under control, and really putting the markets, all kinds of markets, into a panic. We had the long bond last year. The bond market delivered its worst return, I believe, certainly through, I think it was October, the worst return since the 1700s. You have to go back that far, and therefore the risk of higher interest rates was killing long duration assets. And of course, innovation is very long duration. So I think something's changed. I think their tune has changed. I think they're less worried about inflation. Most importantly, less worried about a wage price spiral, which defined the 70s inflation.
Kathy, Brian here, always good to get some time with you. Do you think the Fed has to start cutting rates perhaps sooner than it believes?
I think the bond market is suggesting that is so. Yes, we've seen the deflation in the pipeline, as Julie mentioned. It started with commodities, and then during the holidays we saw massive discounts. We've seen used car prices. I think they're down 14% year over year, having peaked at up 55% year over year. So some of the leading indicators that caused the spike in inflation, and we think it was primarily supply or shock induced, some of those are unwinding, and we think they're going to continue to unwind faster than most people think. I think the one little wrinkle here is we're seeing a backup in gold prices, copper prices, in anticipation of China coming back and driving up these prices. We don't think that's going to be the case, particularly with oil prices, because we believe that China's been building inventories during this time period, especially in oil, since it's been getting oil for a 40% discount from Russia.
Kathy, with regards to all of this, I'm curious about, because we know you're all in on innovation all the time, and you have a newish venture fund to that effect. At times like this, we do hear that there is less investment in things like innovation, right? In private markets to some extent. There's at least concern that there's going to be less investment in those areas with all of the cutbacks we're seeing in public companies. What are you seeing on the ground and with the venture work that you're doing?
Well, the leading indicator for what we're seeing in the private markets was what happened in the public markets in the last 2 years. Innovation was pummeled, especially the companies that won't be highly profitable for, let's say, 5 years. They were hit especially hard. And of course, in the private market, that's primarily what we have. The private market lagged the public market. And now we're seeing stabilization in the public markets. I think the idea that interest rates may be near their peaks, certainly long-term rates seem to have peaked, will be very reassuring to both the public and the private markets. So I think if you look at our Big Ideas report, we just published it 2 days ago. Big Ideas, it's on ark-invest.com. You will see innovation, opportunities, the likes of which we have never seen before. We believe that innovation is priced in the public equity market, in the markets, both public and private, at roughly $13 trillion. So that's roughly, I'm going to say it's 10% of the total market values out there. And we believe that 13 trillion is going to scale at a 40% annualized rate over the next 8 years to 200 trillion by 2030. Now, the driver of this powerful move is primarily artificial intelligence. It is catalyzing all kinds of changes in all kinds of industries. And I don't think that investors have done enough research on how profound this impact is going to be. Right. One of the reasons we give our research away is we want to help investors, but not only investors, we want to help, parents and grandparents guide their children and grandchildren to the right side of change. We want investors to get to the right side of change. And, we've been saying for quite some time that the right side of change is more in the innovation space, clearly, given how much is taking place, than it is in the benchmarks. We believe that the innovation we're seeing today around multi-omics sequencing, robotics, energy storage, artificial intelligence, and blockchain technology is going to disrupt the traditional world order. And if we're right on what's going to happen here, then the traditional benchmarks, the broad-based benchmarks, are probably not going to be a very productive place to invest, certainly relative to innovation during the next 5 to 10 years.
Kathy, we're going to hit pause on this for just a moment, because I'm glad you brought up AI, because one of our reporters has been digging into the public market action that we have been seeing. So just stay around, and we're going to pick up this AI discussion in a moment, because that buzz, in particular around ChatGPT, has exploded since its late November debut. Its capacity to complete tasks like coding, writing content, and entertaining users. It has investors trading the hype, and it's sending both leading and under-the-radar artificial intelligence stocks higher. Our Inez Ferre is joining us now to talk a little bit about that rally, and then we're going to circle back with Kathy in just a moment. Inez, what have you been seeing?
Yeah, Julia, and we have been seeing AI-related stocks really skyrocket over the last month. I want to show you on our Wi-Fi interactive board. You will see here. First, I want to show you C3.ai. This company went public back in December 2020. It's an AI software company. Its clients include the U.S. Air Force, 3M, Shell, Bank of America. Take a look. Year to date, up 92%. Now, this stock had been caught up in the tech selling last year, but this year really rallying around this buzz around AI. Of course, on this chart, you'll also see Microsoft, which has invested $10 billion in OpenAI, the maker of ChatGPT. You also see BuzzFeed, which last week was up 310% last week after announcing that it would be using AI tools to create content. And then you have some other smaller cap companies like BigBear.ai. This offers products for healthcare, government, and manufacturing. And year to date, this stock is up significantly, up 405%. You also have this other company called SoundHound. It's a voice AI software company, small company, but nevertheless, year to date, up 14%, also getting caught up in the AI excitement. And there are many uses of AI. There's an analyst over at CFRA Research that talks about cybersecurity and how AI is used with cybersecurity firms. So she was pointing out to CrowdStrike, Palo Alto Network, that year to date, these stocks are up as well. And then we also have to point out that AI has been mentioned during earnings call. I mean, Meta talked about using AI tools to help engineers to be more productive. Palantir back in November talked about Forrester naming Palantir as a leader in artificial intelligence and machine learning. And IBM's Arvind Krishna recently said that AI is projected to contribute $16 trillion to the global economy by 2030. Also saying we have been co-creating with many clients to deploy AI at scale, guys.
Inez, really nice work, really interesting overview of what we've been seeing in the public markets. Let's now bring back in ARK Invest CEO and CIO Kathy Wood, because artificial intelligence, as you alluded to, is one of the themes that you talk about in your Big Ideas 2023 investment thesis. I think what we have to do, and you were just talking about investors educating themselves, a lot of the public-facing excitement has been over things like ChatGPT and, you know, the thing writing stories and writing exam papers, et cetera. What you talk about in your report is more the coding side of things, which is what Inez just highlighted as well. Do you think the market really well understands the potential for AI right now?
I think the market's scrambling to try and understand how AI is going to impact the world. And ChatGPT has captured the investors' imagination, which is fantastic because we believe that innovation has been neglected, certainly in the last 2 years. Badly neglected. And we believe that most investors are very short innovation. You mentioned our venture fund before. We have a big focus on AI in the venture fund. Picks and shovels are very important. Mosaic ML is a private company in which we've invested that is actually speeding up the progress with its software in artificial intelligence. So the name of the fund is ARK Venture. So really, really proud of it. Public-private, starting now because we believe the time is now. In terms of AI, you're right. A lot of what we expect is productivity gains. And so that will accrue to those companies that use AI most effectively. Yes, Meta Platforms was very interesting to hear Mark Zuckerberg last night focus first on AI as opposed to the metaverse. He had been trying to push the idea of the metaverse, we think, before its time. Embracing AI right now and introducing it deeply into the firm to create efficiencies, absolutely the right thing to do. If you think about the revenue opportunities, they may not be as obvious. Sure, the picks and shovels, you mentioned NVIDIA, but we believe that the hidden gems that will benefit perhaps the most from artificial intelligence are those companies with proprietary data sets. We use Tesla all the time as a prime example of a lot of technology attributes. One of them is having the largest pools of real world driving data in the world. In fact, it has more of that kind of data, orders of magnitude more of that kind of data than all of the other auto manufacturers and technology companies involved in transportation around the world. So we believe that it will be in the pole position for the autonomous taxi platform opportunity, which is a software as a service opportunity with massive margins. And it's also a winner take most opportunity. The company that is able to get an autonomous vehicle from point A to point B, the most safely and quickly is going to be the winner. That's going to be the go-to service. So we're looking for those sorts of opportunities. In the genomic space, Exact Sciences, and we have models of both of these companies along with our assumptions on GitHub, actually. But Exact Sciences probably has more data because of its premier position in oncology molecular diagnostic testing than any other company in the world. And it is training the data with artificial intelligence so that it can help surface cancer in stage 1. So again, here, the company with the most data, the most proprietary data, and the right domain expertise and AI expertise. So those three things: domain expertise. These are scientists with a deep understanding of biology, AI expertise, and data. So those are the kinds of companies we're looking for.
Kathy, when we think about AI and the mentions that it's been getting, even in earnings calls, it's hard not to think that it won't be to, at least this year in 2023, what blockchain mentions were to companies in 2017 and early 2018. You had every company from Roblox and IBM and Amazon and Meta all talking about how they were going to integrate blockchain and how big it was going to be for their business. So for us to avoid that, what is the actual timeline for delivery that we should be kind of grading these companies on with regard to delivering some type of AI solution within their own product and service?
Well, I think what I would be looking for a little bit more, and it is how are companies harnessing AI for their own businesses? Do they have these proprietary data sets? So that's the first thing, because AI is going to enable the most massive productivity increase in our history. And we think that the productivity gains are going to be astounding and shocking. However, those companies who do not embrace this rapidly enough are probably going to lose competitively. So I would be looking at this more, are they going on this offensively within their own organizations? Do they have proprietary data? And then in terms of solution sets, as you say, these are going to be longer term, right? So Tesla, autonomous taxi platforms, Elon thinks he will launch within the next year. We are thinking within the next 18 months to 2 years. But the difference between AI, which is really the next generation software, and blockchain technology, is that this was a dream in really the tech and telecom bubble. It's taken breakthroughs, cloud computing in 2006 with AWS, deep learning, the breakthrough in 2012, and it's taken cost declines. Costs were way too high until now. We're now ready for prime time for the use of artificial intelligence to increase productivity within organizations and increase profitability. And yes, create new products and services, which will take time.
Kathy, you mentioned Tesla. It's a name you and I have talked about before. Do you think Elon is eroding the longer-term premium positioning of Tesla by cutting prices? And just given the competition, look, we heard from GM this week with all the EVs it's coming to market with. Do you think more price cuts are coming at Tesla just to keep competitors at bay?
Well, I actually think it's the other way around. I think that traditional auto manufacturers are going to have trouble keeping up with the price declines that Tesla's technology is enabling. The secret to success in innovation is driving costs down. Technology follows learning curves. So figure out what that learning curve is. That's a big part of our research. And in the case of batteries, for every cumulative doubling in the number of units produced, battery costs decline by 28%. Elon is on a different battery cost curve decline. He is leveraged off the consumer electronics industry, those kinds of batteries that go into laptops and phones, and others. Automakers and auto analysts made fun of him I remember this very clearly, 2015, 16, 17. He absolutely chose the right technology, and I think others are rethinking it now. If they do not switch over to this kind of battery technology, they will not be able to catch up with Tesla in terms of price declines without losing money. Whereas Tesla's gross margins are probably going to continue moving up on balance, even as it is cutting prices, because its unit volumes, the economies of scale are going to be so significant.
Kathy, I want to switch gears and ask you about one of the other predictions in the report, and that has to do with Bitcoin. And of course, this has gotten a lot of attention, as many of your predictions do, that you guys are still looking for $1 million or more in Bitcoin value going out to 2030. As I said, this is a controversial take after the drubbing and then some that we have seen in Bitcoin. Walk me through it here. Like, how do we get from here to there?
Yes, and you can see the building blocks in Big Ideas 2023. But if you and the assumptions you'll see are very conservative. In fact, we've dialed them down. From just take institutional managers looking at Bitcoin as a new asset class, and they are. We've seen Coinbase and BlackRock hook up recently. It's because institutional investors want access to this new asset class, which the returns of which, the correlation of the returns are low, which is exactly what they're looking for. Let me just step back and just say, last year was a disaster for crypto generally. However, if you look at the Bitcoin blockchain, it did not skip a beat. No transaction was interrupted. It did what we thought it was going to do. And it is no surprise to us that Sam Bankman-Fried did not like Bitcoin. Why? It's completely decentralized and completely transparent. And he couldn't control it. His firm, FTX, was completely centralized and opaque. So we think that as investors reflect on what happened last year, the failures were those companies that were not decentralized, were not transparent. Bitcoin didn't skip a beat. And if you watch what's going on, especially in emerging markets, there's hyperinflation all over the world as their currencies have fallen apart and as their fiscal and monetary responses to COVID are now proving in some cases to be disastrous. Those individuals, those populations need a fallback, an insurance policy like Bitcoin, as do high net worth individuals who are worried that their wealth will be confiscated. Inflation is confiscation of wealth, but then there's outright confiscation. And I'm sure that there are individuals in the troubled spots of the world, the Russias, the controversies in China, who are looking for that fallback in case something really wrong happens to them in these countries. There are tycoons who understand what their risks are. So we believe that in insurance policies, that Bitcoin is probably the best insurance policy. Just keep that key in your head, and at some point you'll be able to cross a border and reclaim your wealth.
Kathy, we could spend the whole hour just talking about Bitcoin, but I do have one last question for you before we have to let you go, and that's about ARK itself and your benchmark ETF, ARK-K. As we talked over the last year, and as your ETF dramatically underperformed, you said, well, it's not surprising during this time that we would see declines. You said that even towards the end of 2021 that you thought things were getting a little toppy. Where are you now? What kind of year is ARK going to have?
Well, we have a 5-year investment time horizon. I'll just tell you that our confidence in our outlook over the next 5 years has increased dramatically. I would say that what happened with Fed policy last year, which we thought was unnecessary, and we were in print saying that we've come to the end of that, and the market sees that, and I think that the time horizons, which shrunk to almost nothing. In fact, we saw investors looking backwards to guide them. They wanted, they were looking back at the cash flow over the past year to guide their investment decisions. We think real returns are going to be delivered from those companies that are going to deliver on the innovation around which we have centered our research and investing over the next 5 years. And we do think now that the shock of interest rates going up 18-fold, I think it was. We've never seen this in history. We've never seen a bond market act as badly since the 1700s. So, of course, long duration assets were going to be the primary victim. We believe that chapter is over, and that you never say the coast is clear. There are always risks, but we think we're on the other side of the most difficult time that innovation oriented strategies have ever had. I've never seen anything like that in my career. We're on the other side of it, and we think the future is bright for innovation. We're really excited, as you can see from our Big Ideas 2023.
Lot of innovation, hopefully fast-tracked as best as possible. ARK Invest CEO and CIO Kathy Wood, we always appreciate the time, and thanks for the wide-ranging conversation.
Thank you so much, Brad, Julie, and Brian.
Thanks. Guys, coming up, a change of tone from Powell, but does it change the trajectory for investors? We're going to speak with BNY Mellon next. So the Fed raised rates once again, and by the expected 25 basis points. Chair Jay Powell reiterating the plan of ongoing increases, but stocks seem to be largely shrugging that off with Powell's comments on disinflation lifting demand for risk assets. Here to discuss, we've got Sonia Meskian, who is the head of U.S. Macro at BNY Mellon Investment Management. Sonia, thank you so much for taking the time here this morning. Your perspective on what Powell had to say and quite frankly, what the markets are giving weight to as well here today.
Sure. Thanks so much for having me. So I would say the big takeaway from this meeting was really the press conference. And within the press conference, it was the fact that Powell basically did not validate / some would dismiss the SCP from December, i.e. the dots. Secondarily, he didn't push back against the recent easing in financial conditions, but I think the most important part was that he essentially said we're not really committed to the dots in December. And the December dots were a big hawkish move for the Fed, where they really took, if you recall, they really took their estimate of the target rate for the cycle to 5%, if not higher. And the fact that he kind of essentially dialed that back, is really what I think is behind this market rally.
And so, does that now mean soft landing, free and clear? That's the base case at this point?
Well, I think it really doesn't it's the one episode in the saga. It's not necessarily the end of the saga. I would say that certainly he talked a lot about everything that the market already knows, which is that goods inflation is coming down. We're really having goods disinflation, which is the mirror image of what we were having when COVID first hit. It's certainly being helped by China reopening. We will be having some disinflation in new leases and shelter in general, at least in the first half of 2023. What's happening with services inflation overall is still a big question. Now it's all about the labor market. And the question for us is really, well, do they need to have the labor market weaken substantially, i.e. have a recession in order to contain services inflation and kind of really nip in the bud that potential for a wage price spiral that is still out there? Or is this just going to happen on its own?
Sonia, despite the Fed sounding a little more dovish yesterday, they still raised rates. The ECB, they raised rates today. So did the BOV. Yeah. Do you think all these rate increases by global central banks still has the global economy on path for recession?
I would say not necessarily. We really had, and each of these economies is somewhat different. We had a big shock to supply and demand coming from COVID that is still being kind of worked through. I think that in the U.S. specifically, supply and demand is still not in equilibrium. Powell did allude to that multiple times yesterday. And the imbalance is still quite evident in the labor market specifically. Where that new equilibrium will it be at roughly the same place where it was pre-COVID or somewhere different, is really quite crucial to policymakers and to the economy overall. But they don't really know where that will be. And they're erring on the side of caution, e.g. on the side of being dovish right now.
Sonia, we got to leave things there for today, but we certainly do appreciate the time. Sonia Meskian, who is the head of U.S. Macro over at BNY Mellon Investment Management. Sonia, thank you again.
Thanks for having me.
Coming up, everyone, cooking up some strong quarterly results. We're going to discuss and speak with the CEO of Brinker International. On the other side, there you see Kevin live on the screen. We'll speak with him in a moment.
Big quarter of sales for Chili's, and Maggiano's owner Brinker International was met with a bit of profit taking by investors. But did the street miss something here with that instant reaction? Brinker International President and CEO Kevin Hochman joins us now. Kevin, always great to get some time with you. I want to start a little non-traditionally here and lock in on Maggiano's. Same-store sales up 21.2% in the most recent quarter. I would argue most investors have never seen that from this brand before. What is it? The nation is just falling back in love with meat sauce, I'm guessing, right?
I wish, well, a big part of it, there was obviously a COVID role in there, but things are returning back to Maggiano's. So, dining rooms are basically recovered, banquets are getting there. But the new thing that created a lot of that growth is off-premise. So as customers flocked to off-premise during COVID, Maggiano's wasn't immune to that. But what we found out was it's an incredibly sticky channel for that brand. Italian food travels great. We were really well positioned to get after it in terms of value. And what we're finding is that off-premise guest, unlike the dining guest, which is more about celebrations, the everyday off-premise guest eating at home, they're coming more often. So we're seeing frequency and we're seeing growth. Off-premise sales were 82% bigger than they were pre-pandemic. So we feel like that's a growth channel going forward, and we're certainly going to get after that.
I do feel like I'm missing out. I was looking at some of those images you were showing next to you, Kevin. I might be missing something out on the Maggiano's Italian food. But outside of that, it looks like you had some success raising prices. How much in terms of menu price did you take at a Chili's and Maggiano's in the quarter? And do you see more opportunities to do so?
Yeah, so Chili's is where we took more of the price, and we were significantly behind the industry the past 3 years in taking pricing. So we're still well below the industry, I think, from a value standpoint. In fact, during the quarter, even though we took some pricing, value scores actually improved. I think it's part of the service improvements that we're making, across the restaurants in terms of adding labor to the restaurants, as well as simplifying things for both the heart of house teams as well as the front of house servers. And so, we feel pretty good about where we are. We still have protected core price points of $10.99, which is a complete meal, unlimited chips and salsa. We talked about this the last time I was on, the burger and fries and unlimited soft drink. And we haven't taken that price up. So if that guest only has that amount of money to spend at casual dining or at Chili's, they can still come in and have really, quite frankly, unbeatable value within all of restaurants. But we've been able to take some of that inflation that we saw in cost of goods and flow it through to the guest. And we're not seeing really much pushback on that.
The vibe on the street, Kevin, is that Chili's was underinvested in for many years before your arrival. Where are you putting your capital to work? Is it more machines? Is it new equipment in the restaurants? And then how will you be showing up on TV again soon?
Yeah, so it starts with our strategy, which is we want to get back to restaurants that no matter where you go in the country, no matter what day you come into a Chili's, you have an amazing experience with the servers, great food, in a fun and inviting atmosphere. And in order to do that, one, we're making some investments back in our labor model, and that's adding both help for the front of house servers so that they can spend more time with the tables and the guests, as well as some help for the heart of house so that our general managers can rise up and really do a lot of leading in the restaurant. We've seen that have incredible success both in hourly turnover and in general manager turnover. Manager turnover is now less than it was pre-pandemic, which we know is a future sign for better service going forward because we have continuity with management. The second area is repairs and maintenance. So we did defer some maintenance during COVID, and we want to catch up on that, whether it's floor tiles or coolers or any equipment. Every Chili's should have consistently well maintained equipment. And then the third, as you mentioned, is we're going to get back on air with advertising. And so when we have industry leading value like $10.99, we want to advertise it. The whole point of having value that good is to drive incremental traffic. And so, later this quarter, we're going to have an all new advertising campaign. We've just restocked that marketing team. We've got George Felix as our new chief marketing officer. And then Jesse Johnson, who comes from the world-class agency, Wieden & Kennedy, has come to work for Chili's full time to lead our advertising. So I'm really bullish about what that advertising campaign is going to do. And, let's see it drive some traffic back into the restaurants.
Kevin, looking within the franchise segment for the business, what are you hearing from franchisees right now that are trying to retain that foot traffic into the dining experience? And what are they asking for from you and from the leadership at Brinker?
Yeah, we're primarily owned. We own our own restaurants, so I think we're only about 10% franchised. And then certainly in the U.S., it's even less than that. I do talk with them pretty regularly, though, because they're an important source of inputs about ideas. And, what we're hearing is that we're making all the right moves as a bigger brand. So simplifying inside the restaurant, making sure that the team members are feeling supported. And the few franchisees that we have are pretty excited about the direction that we're headed in. But the idea of how do we make the restaurants easier to work in? How do we make sure that we're being really smart with a tighter, more efficient menu? We can do those things, and we're gonna retain and attract employees. We're gonna grow margins, and franchisees or our company-owned stores, they're all gonna do better because of it.
Brinker International CEO and President Kevin Hochman joining us here today. Kevin, thanks so much for the time.
Hey, thanks so much, Brad. Appreciate it.
Absolutely. Coming up, everyone, a new study on Merck's COVID-19 pills is raising some concerns. Anjali Kamlani has the details next.
Merck is now forecasting sales of its COVID-19 antiviral pill to fall about $1 billion this year, as demand is expected to fall with the end of the public emergency. And separately, a new study identified COVID-19 mutations linked to the use of Merck's pills in viral samples taken from patients. For more on the risks linked to these drug mutations and their impact on Merck, let's get to Yahoo Finance's Anjali Kamlani. Can you explain this to us?
Yes. You actually already understand this concept.
Okay.
Think of antibiotic resistance, right? So we know that certain bacterial infections build up that resistance to the antibiotics, and we've now been dealing with that in hospitals, superbugs, et cetera. This is sort of similar to that. So this is not something that was completely unexpected. Prior to approval even, there were many experts pointing to the methodology that this treatment uses and the fact that it could in fact follow that kind of process. And here we have a study showing in a small sample that could be happening. Merck, of course, denying that this is leading to any mutations, but there are experts warning about and looking into what the impact of this information could be. In particular, the fact that these mutations could be linked to the drug, but also the fact that Merck's pill has not been the favored one among the two options that have been out right now. Paxlovid, of course, we know Pfizer's pill has been the one that is more favored, but it also has drug interactions. So molnupiravir has been the one that has been a go-to as a backup. And now with the approval pending in China, could have a much bigger market. We've talked about that on this show. So all in all, a really interesting sort of dynamic for Merck to deal with. And we'll just have to see how it truly does does play out.
But so does Paxlovid not carry a similar kind of effect? And do the vaccines not have a similar kind of effect where it sort of drives the virus to mutate?
There has been discussion about that, right? Whether or not these vaccines are causing adaptation and the like. But as it stands right now, the main driver of mutations that we've been finding is the spread of the virus itself. So every time, and I've said this in very simple terms before, every time the virus is in a body, it has a chance to make a mistake of the copy of the DNA of the virus, and that's what a mutation is. And so that's really where the focus of these variants has been to date. Now, as we get into lower circulation and the like, yes, we're going to see some of these other, sources of mutations come up on the floor.
We had some other earnings come out from the healthcare landscape earlier today as well. Which are the main ones we should be keeping tabs on?
So Bristol Myers Squibb seeing a little bit of reduction in demand there for one of their multiple myeloma drugs, facing a lot of generic competition right now. So keep your eye on that, even though the stock is up right now. And then Eli Lilly, that's another big one, COVID related. We know that their antibody treatment, a monoclonal antibody treatment for the virus was one of the last men standing, but now completely knocked out by these new variants. So they took a hit there on that. And meanwhile, they're also looking at their diabetes drug that is also being studied for weight loss. Really high demand there, but because of a reduction in sales, they took a hit this morning. So those are the two things to look out for.
Yahoo Finance healthcare reporter Anjali Kamlani. Thanks so much, Anj, for breaking those down. Awesome, everyone. Guys, coming up on the other side of this short break, we'll dive into some more earnings that we're tracking here on the desk. Harley Davidson, rev it up, next. Welcome back, everyone. It's time for Cover Time. 3 stories, 1 minute each. We start with this on the day. Harley Davidson shares climbing higher this morning, boosted by an 18% pop in global shipments year over year. This as the motorcycle company continues its turnaround efforts. This is after pausing production here. You're taking a look at shares on the screen, heavily in the green on the day, revving higher here on this Thursday.
Saz, I know you got stuff to say about this one.
Yeah, Harley's a good quarter considering all the recession fears cycling around out there and the fact that a lot of people are buying electric cars and electric trucks. I mean, Harley shipments were up double digits and they were able to push through higher prices for its motorcycles. That is a good thing to see. Also, a little fun nugget here, Livewire, that's our electric vehicle division they spun off but still have a stake in. They shipped 597 electric motorcycles last year. Now, the division did lose $85 million, hence it was a good thing they split it off a couple months ago.
Yeah, you know, those price increases help the company's margins beat estimates, and for the full year, operating margin is going to be 14.1% to 14.6%. Margin improvement is what investors want right now, Saz.
All right, from that to candy. I'm looking at Hershey's here. The stock is up nice here in the early going following this company's earnings. Stock is up about 20% over the past year, outperforming the S&P 500. And I think this quarter explains why. Hershey, their sales in their U.S. candy, mint, and gum segment, their most important segment, up 10.7%, in large part due to higher prices. Gum did well. Chocolate did well. Despite these higher price increases. And Hershey's just been executing. This quarter is not a one-off. This has been happening really under CM Michelle Buck for some time, but really has been gaining steam the past 3 quarters.
Yeah, good Pennsylvania company here. Saz, you know I had to give him that PA shout-out. I took my senior trip there, physics trip in high school to Hershey Park in PA, so shout-out to them there. But look, some of those price increases you're talking about, it's continuing to kind of permeate into this year as well. Net price realization going to help that net sales growth that they're anticipating going forward in their outlook of 6 to 8% here, too.
I took my share of trips to Chocolate World as well.
Yeah?
Living just over the border in Maryland, it was also a frequent trip for my family. The goose is loose. Canada Goose is sinking today after the apparel maker slashed, it might be the apparel maker, I don't know, it slashed its outlook, spurred by slower sales, leading to higher inventories, which rose about 30%. I mean, it's interesting here. I do have to wonder, there are a couple of different things here going on, right? You had, obviously, China sales that were still weak during the last quarter before you saw reopening. You always have to wonder if weather's a factor, right? It has not been, up until now, that cold of a winter in the United States. So is that having an effect? You do see some other sort of high-end apparel and retail companies that have held up well. Yeah. So it's not that the high-end consumer is sort of deteriorating here necessarily.
I mean, the prices that they charge, it's no surprise that their gross margins kind of stay in this locked-in range of about 72%. I mean, my goodness, anybody who's ever purchased any of their products, you say that much for a vest? Wink, wink, Saz?
Hey, the jacket kept me warm in Davos, but I will say this, the stock does not like historically when inventories are rising ahead of sales. You will see the stock likely under pressure for a good bit.
Ooh, right at the buzzer. Yeah. Well played there,
it's like I've done this before, right?
All right, that does it for us. Obviously, keep tuned for the AAA after the bell, Amazon, Alphabet, and Apple, which the boys will be covering in their after the bell coverage. Coming up next, though, Rochelle Kubo is going to do a deeper dive into those Meta earnings with a Citi analyst. Keep it right here.
Welcome to Yahoo Finance Live. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this morning. Risk on. The Nasdaq jumps and Bitcoin also getting a tailwind as the Fed's slightly dovish tone is enough for investors to look past more rate hikes. So are we headed for that soft landing? And what's the trade? We'll break it all down. And Meta reverse. Mark Zuckerberg announces a year of efficiency, and the market really likes what it sees. So is the push to the metaverse taking a back seat? We'll dive into that story with an analyst. And of course, attention turns to Apple. It's expected to post its first revenue decline since 2019. We'll talk iPhone demand, consumer health, and tell you why the earnings call matters and why we'll be reacting to it live this evening. But first, let's check on those major indices the day after that Fed announcement. A mixed picture here. We see the Dow slightly weighed down here by some of the health tech stocks, as well as some Chinese stocks as well, down just about 1/3%. The S&P 500, though, in positive territory here, up about just shy of 1.5%. And the tech-heavy Nasdaq, enjoying some of those tech earnings, up about 2.9%. That's about 340 points. Let's also check in on the Treasury market. The bond yields seem to be suggesting that dovish tone is sinking in for them as well. You see the 5-year down 1.33%, and the 10-year down 1%, and the 30-year down about 0.5%, as they seem to be expecting that soft landing. Well, hopes of a soft landing pull into view following a more optimistic tone from Fed Chair Jerome Powell. But what would markets look like in this favorable scenario for the U.S. economy? We have our Jared Blickery here to break down the details. Hey, Jared.
Hi there. So this is a drinking game, right? Soft landing. We got to explain and break down what this is. So the definition of a soft landing is when the Federal Reserve is noticing that the economy is getting overheated. And in terms of inflation, that has already happened. That was a really big story that started last year, actually the year before. So if the Fed is able to whip inflation without a recession, that is a soft landing. Now, unemployment. We talk about the Fed's dual mandate here that has to do with stable prices, and that's a problem for the Fed right now. Prices are not stable, and also maximum unemployment or maximum employment. And so that's what we're also seeing right now. Now, for the Fed to get inflation under control, it's thinking that it has to get unemployment up. In other words, people have to lose jobs. And of course, when people lose too many jobs, that leads to a recession. So the hope is the Fed can make it a little bit more difficult for people to buy some of the things that they want to, but not without losing too many jobs. That would be a soft landing. Has this ever happened even? Guess what? Greenspan's 1994 Fed did that way back when. That would be 29 years ago. So we'll see if it happens again today. But even Powell, if you check out some of the things he said yesterday, we're going to get into that right now, may not be fait accompli. In fact, he might be saying that the market has already gotten ahead of itself. So his job, and I'm going to be quoting Macro Alf here, some of these tweets came out yesterday. Powell's main job on Wednesday was to push back against easier financial conditions. What is that? That means rising stocks. Guess what? Stocks have been rising this year. Yields have been moderating, going downward. So financial conditions have been getting easier this year, even though they're still at depressed levels. He didn't push nearly back enough, and so markets are rallying hard in his face. Now, remember, Neil Kashkari, a Fed member, said last year that he doesn't want to see a stock market that's rallying in the face of all this. So that may be a problem. The thing is, Alf is saying this won't stop unless data comes in very hot. Oh my goodness, the Fed will turn hawkish again, or data comes in recessionary like, oh my goodness, this is not a soft landing. Now let me break that down as well, because when it comes to bear markets in recessions or bear markets without recessions, the two are very different. Bear markets without recessions tend to get resolved quickly, and I think that's what the market is betting on right here. But if we do see a recession, and a lot of indicators are pointing to April and May, not just one, about 5 or 6, if we do get a recession, probably going to go down, revisit those lows in the indices, and also probably exceed them to the downside. So in the meantime, the window for the misplaced soft landing narrative is now extended. And just one more slide here real quick. This has to do with Powell saying yesterday, we need substantially more evidence to be confident about inflation returning to 2%. And he gets to the heart of the matter. In particular, we want to see core non-housing services inflation running at 4% annualized with no progress there. In fact, he said that could be a problem. They're looking at core non-housing services. And what he points to, yes, it's dropped down from this high of about 11% to 4% right now. But when you look at the composition, it's all in medical care. So that could be a sticky component. And if that's what CPI print next month and the month after, guess what? Markets are probably going to go down hard. So markets may be a little too ebullient right now. We'll have to see how this resolves, but even Powell not entirely confident in the stock reaction to this.
Yeah, and that uncertainty really not helping. So investors pretty much running away with the narrative that they need right now. Jared Blakery, thank you for that breakdown. Great stuff. Well, as the Fed continues its efforts towards taming inflation, concerns over economic growth remain top of mind for investors. Here with what Fed Chair Powell Jerome had to say on the economy, boosting hopes of a soft landing. Let's take a listen.
Different participants have different forecasts, but generally those forecasts are for continued subdued growth, some softening in the labor market, but not a recession, not a recession.
While Powell feeds markets soft landing hopes, recession fears still hang overhead as the disconnect on the Federal Reserve's tone persists. We're here to discuss how to invest following yesterday's remarks is Uma Moriarty, Center Square Global ESG lead and senior investment strategist. Good to see you here, Uma. So it does seem that the markets are seeing a light at the end of the tunnel much sooner than apparently Fed Chair Powell is seeing. How are they reading the room right now, these investors?
Great to be here. You know, a lot of what the commentary and the data has been indicating is that, you know, we're seeing the markets somewhat do the Fed's job for it, right? So the question then becomes, in terms of what the Fed is trying to achieve right now, did the markets price in a good chunk of that going into this year, right? In 2022, we saw a lot of focus on inflation, kind of the primary driver at the beginning of the year. And then some of that attention really flipped into what happens in a recession type of an environment. And so I think there's a chance that the market might have, you know, gotten ahead of where the Fed was in terms of pricing in a recession and what that really means for equities and prices here. And so that really might be part of what you're seeing today in terms of the reaction past the Fed meeting yesterday.
So is a recession then the only way to get to that inflation target? Because you're saying inflation doesn't get fixed until demand slows, demand doesn't slow until labor market cools, labor market doesn't cool until we get into recession. At what point do we see those dominoes start to fall?
Yeah, you know, great point. I think at this point, what we're really expecting is the fact that in order for, as you mentioned, that services inflation to really come off, which is what the Fed seems to be looking at, you need to have that labor market slow. You're not going to see the labor market slow to the extent that achieves that inflationary target without really pushing us into a recession. And we've seen those types of indicators really across the board. If you look at the bond market, if you look at what expectations are from just a growth perspective, I think the consensus still seems to be that we are expecting some sort of an economic slowdown in the back half of this year. The question just becomes, can the consumer really get through this type of an economic downturn without causing significant impacts from an earnings perspective? And so that's something that we're watching and something that we think is a factor that makes real estate today a really attractive opportunity for investors that are looking for something in their portfolios that can survive some of these economic ups and downs.
So let's get into that, because a lot of people are now wondering, okay, what's next in terms of what are the good investment strategies now that the Fed is in this more normalized 25 basis point hike rate? And you like REITs. So what positions them better than other investments in this sort of environment when you're not sure if it'll be a soft landing or perhaps a deeper recession?
Yeah, great point. You know, REITs and real estate in general have the capacity to withstand the impacts of more volatile economic times, primarily because of the way that the cash flows for these REITs are structured, right? We're based on the concept of longer term leases, and you see cash flows for REITs being much less volatile than equities more broadly. And so as you even look at for earnings expectations and how those revisions have been coming in over the last couple of months, the broader equity market has seen much stronger earnings revisions downward compared to the REIT market overall. And that's really being driven by the fact that the REITs still continue to have fairly steady cash flows despite of what you might see from an economic cycle perspective.
Now, even within REITs, obviously, there are certain subsectors. You have data centers, towers, healthcare, rental housing, etc. What's the criteria that you're using right now to really pick out the best opportunities in REITs?
You know, at Center Square, we're long-term investors. We think about the types of secular demand drivers that are really going to be helping some of these business models going forward, right? So you mentioned a couple of those items. Healthcare, for example, we have an aging population that needs healthcare, whether it is senior housing, whether it is life science lab space that is developing new technologies in terms of treatments and things like that, right? So those are types of areas within real estate where you see a lot of really strong secular demand drivers businesses. And then also really focused on the strength of the balance sheet. You're focused on the quality of the management team. Those are all things that you're looking for as kind of table stakes, right? At this point, when you're looking at a potential recession, but we're focused on those areas within real estate where we do see those secular thematics that are going to be driving demand for years, despite what might happen in the economy.
Well, always an opportunity to be found in this environment. Uma Moriarty, Center Square Global ESG Lead and Senior Investment Strategist. Thank you for joining me this morning. All right, well, shares of Amazon pushing higher this morning on the back of Meta's earnings report as its new efficiency mentality fuels optimism on the company's future. With Meta back on track, the prospects are looking brighter for Amazon's earnings as it gears up to report its quarterly results after the bell. And investors will be eager to watch how things shake out for the e-commerce giant and, of course, the tone for the coming year after it, like Meta participated in the wave of layoffs amid cost-cutting efforts. All right, coming up, Meta shares moving higher as they enter what Mark Zuckerberg calls the year of efficiency. We dive into the earnings report next. Meta in focus this morning as shares jumping following a strong earnings report. CEO Mark Zuckerberg on the call says the company is aiming to be more efficient in 2023. Take a listen.
2022 was a challenging year, but I think we ended it having made good progress on our main priorities and setting ourselves up to deliver better results this year as long as we keep pushing on efficiency.
Joining us now to break it all down is Ronald Josie, Citi Senior Analyst of the Internet Sector. Good to see you, Ron. So now this is interesting. Usually, ever since Meta changed its name, it has not been smooth sailing at all. But investors really honing in on this forward guidance, what they saw with engagement, and really hear about this more disciplined use of their finances. What did you like the most in this report?
Michelle, there was a lot to like, but to be clear, it's still relatively early days as we try to get back to a post-IDFA world, so to speak. But frankly, we went into this print looking for insights around maybe improved savings or efficiencies on OPEX and CAPEX. We got that. We went into the print looking for greater overall engagement, and we heard that basically users on WhatsApp, Instagram, and Facebook are at all-time highs, which we think is because of Reels and just greater overall discovery of content across the service. And we went in hoping to get some insights that, okay, we're now more than lapping Apple's IDFA changes. So all these investments that Meta's done over the past year plus, what's the progress here? And what we found was that conversion rates for advertisers grew 20% in the quarter. And so when we think about conversion rates going up, pricing is actually lower for a variety of reasons. That speaks to high return on ad spend. And so we think coming out of this quarter that, you have definitely some light at the end of the tunnel in terms of perhaps the top line can improve as the year goes on. Engagement continues to be strong, and you have a more efficient overall business. So there's a lot to like here. But to be clear, it's still early days, and there's a lot of macro uncertainty that's out there still, but certainly more positive.
I mean, we certainly see that when you look at some of these analyst upgrades that we saw to Meta and increases to price targets here. When you look at looking at Piper Sandler, their rating, they're going up to $215 for their price target. We did see that overweight ratings for Piper Sandler and JP Morgan, some of the higher price targets, JP Morgan, who also named Meta, predicting them to be the internet company of 2023. But is all of this enough to make us forget the metaverse itself and the investments that Facebook is making in this and where they still plan to go?
Yeah, well, I mean, I think one of the key and clear takeaways from the call yesterday was that metaverse investments will absolutely continue. And that's something that, is going to be a part of the business because that's more of a 5-10 plus year, lookout in terms of the opportunity on the metaverse and VR, et cetera. But the core business is doing better. And so we walked away from this just feeling as if, D-Stock to own is certainly one of our top picks, our top advertising pick for sure. And they're operating better, and we're seeing that top line do better as well. And our price target's actually higher than the one on the screen. And so, we're pretty excited about what Meta can do. We're not forgetting about the investments in the metaverse and Reality Labs. We just think the majority investments are going towards the core family of apps or social networking sites that they're running, and that should continue because that's where we're seeing the greater returns.
And certainly upbeat as well on their total operating expenses as well, some cutting there. But which parts of the business then do you expect them to start cutting back on? Where will we see those trimming come from?
Well, we saw a lot of it already, right? I mean, so we saw the massive reduction in force that they announced in November, and we saw as a result. This is now the second time they've lowered their operating expense and CapEx guidance since 3Q earnings. The investments that we're going to see sort of pull off, look, I mean, it might be we're not going to see pedal to the metal on the metaverse as much, right? But we are going to see, in my view, continued investments on engagement, continued investments on greater signal and return and on higher sort of focus on return on ad spend around the advertising side. So we're hearing a lot around newer ad products with Advantage Plus, with sponsored reels, with click to message, shop ads, et cetera. I think you're going to still see a lot of innovation here. And you can do a lot of innovation with $90+ billion in OpEx spend and call it 30 some odd, 33 billion, 31 billion in CapEx. So we're still going to see investments, just maybe not as much on maybe the fringe ideas of what they're investing in before.
And obviously, Meta not immune to a lot of these job cuts. We're probably going to see more based on what Mark Zuckerberg was saying. He's saying they're working on flattening their organization structure, removing some layers of middle management so they can make decisions faster, be more nimble. How deep do you think the cuts are going to have to get to really get them to where they want to be?
Well, I would tell you, Michelle, the key thing coming out of this quarter isn't necessarily that, oh my gosh, advertising is back, because there's still a lot of room to go in terms of getting to just traditional growth rates of double digits, right? But we did come out of this quarter just feeling a lot better around the cost side. And so when we look at, from our perspective, we can hang our hat now on perhaps our earnings per share of over $10 for this year, over $12+ for next year. And as long as we have that baseline, I think anything additional to that is basically will help the overall business do better. So whether there's more cuts or not, I'm sure there's some more trims as the year goes on, as the macro uncertainty unfolds, and we heard all the macro issues yesterday with rate hikes, et cetera. So I think there's still potential for cuts. However, frankly, we came out of this quarter feeling as if They've made a good amount already. I think the market and the stock can support a higher multiple over over the next year or so. And if there's more cuts to go, I think they can actually do that without impacting that top line growth that we're looking for.
Investors certainly seem to think so. This will be an interesting one to follow, see how this plays out. If they can meet all those cuts that they're trying to make, get to that year of efficiency. Ronald Josie there, Citi Senior Analyst, thank you for joining me. All right, well, ChatGPT is among the fastest growing consumer apps in internet history. And with nearly 60 million monthly active users in December, it's showing no signs of slowing down. Well, our team spoke to Kathy Wood, ARK Invest founder and CEO, about the latest trend. Take a listen to what she had to say.
What I would be looking for a little bit more, and it is how are companies harnessing AI for their own businesses? Do they have these proprietary data sets? So that's the first thing, because AI is going to enable the most massive productivity increase in our history.
Well, joining us now to break down the OpenAI computer program is Yahoo Finance's Ali Garfinkel. We know that Kathy likes to do a long play. She's usually ahead of the game on some of these things, still waiting for them to pay off. But what about ChatGPT?
So, Rochelle, ChatGPT is on pace to pass 100 million active monthly users after just 2 months since its launch. This data is from UBS, and I want to put in some context the company that this puts ChatGPT in. So, here you have the months to reach 100 million global active monthly users, right? You have Instagram at 30 months, Pinterest at 41, you have TikTok at an incredible 9, and you have ChatGPT at 2. Now, for context, you think about Google Translate, Spotify, Uber. We think of these as spectacularly successful apps, tech problems aside, and that is an incredibly important part of this. The other key fact here, Rochelle, the total addressable market for generative AI could be over $1 trillion. And ChatGPT is currently averaging 13 million unique visitors per day, which is more than double what we saw in December. So some of this data, frankly, is pretty jaw-dropping. We're seeing applications all over the place.
I mean, when you consider just how recently we even found out about this company, only a few years, and being just 2 months away from hitting that level, I mean, it really is mind-boggling. Now, is there then any company looking to compete with ChatGPT?
There certainly are a lot of would-be competitors. Of course, the most famous case of this is Google. ChatGPT has been called a Google killer. I personally think that while talking about ChatGPT as a Google killer is a little overblown, it doesn't change the fact that Google is going to be asked about ChatGPT and its plans with generative AI today in its earnings call. At the same time, from China, you also have Baidu, which is positioning itself as China's top AI developer. So they're reportedly getting in the game, and Baidu stock has popped on the news. Lastly, even yesterday in Meta's earnings call, Mark Zuckerberg spoke positively about generative AI, saying that he's very optimistic about it and doesn't want to get ahead of the game, but that it's something he's watching. So, Rochelle, there are would-be competitors all around, but we'll see who kind of comes to the fore as the real competitor to ChatGPT.
I mean, this race really is heating up. Fantastic stuff there. Ali Garfinkel there for us. All right, coming up, while Rihanna is set to headline the NFL's big game, it's Apple who headlines the Super Bowl of this week of earnings. We preview what to watch from the tech giant's report coming up next.
Brian Stassi here with Brad Smith, and we're getting ready for our After the Call on Apple earnings, which hit on Thursday after the close. One big number I'm watching is the stock price. Apple stock is up 11% year to date on a lot of hope and optimism. Brad, what you watching?
I'm watching services. I'm watching where those iPhone shipments are actually netting out. So keep a close eye on everything between those products and services, but specifically on that iPhone because it makes up the lion's share of that Apple revenue base.
Are you excited to hear Tim Cook's voice?
Always.
Always.
It's so soothing.
It really is. Me
It's
too.
like butter on a croissant.
That is a perfect way to put it. All right, after the call, Yahoo Finance, check it out on our homepage. We'll be live right after that Apple earnings call ends, a little after 6 o'clock. We'll also be live on YouTube. Watch it, bookmark it, you name it.
All right, biting into the apple, a global revenue slowdown expected at the tech giant as its contemporaries continue shedding jobs. But the company hasn't reported any layoffs yet. The answer in Apple's earnings call after the close. We'll be taking a listen. Here's what to watch with Yahoo Finance's Dan Howley. So, Dan, obviously this will be a big one to watch for investors.
Yeah, this is going to be very big for Apple. And I just, I want to point out some of the numbers that we're expecting from the company in this report. Revenue is expected to be down year over year for the first time since 2019 through 2020 and 2021, 2022. Apple essentially recorded record revenue for each quarter, and now we're seeing them kind of fall back. We're expecting 121.1 billion versus 123.9 billion. Earnings per share also supposed to be down over year to $1.94 versus $2.10 last year. And the big contributor to that, well, two of the big contributors to that here are really Mac and iPhone revenue. Now, iPhone revenue, obviously the bigger share, as Brad pointed out in that incredible preview there. The revenue is expected to come in at $68.3 billion. That's versus the $71.6 billion we saw last year. And then Mac revenue, $9.72 billion versus the $10.8 billion. So as far as the iPhone revenue, there's two stories going on here. One is availability and two is demand. During Q1, which encompasses the December timeframe, November, as well as the general holiday season, we saw issues with Apple's supplier, Foxconn, in China, where there were lockdowns at the factory. We saw worker protests there. That's one of the factories, or the factory that makes the bulk of Apple's iPhone 14 Pro and iPhone 14 Pro Max. That is important because the Pro and Pro Max are two of Apple's more expensive iPhones, and so those naturally mean that Apple gets better margins on those. They're also seemingly selling better, at least from anecdotal evidence, than Apple's iPhone 14 Plus. We had heard that they were cutting back on Plus orders because they just weren't selling as well versus the Pro and Pro Max. So, you can imagine that there were a lot of people who weren't able to get their hands on those. The other is the demand story. And so IDC had said that we're seeing a slowdown in smartphone demand. One of the biggest slowdowns that we've seen in quite some time, actually. And so that also could be impacting Apple, though, according to that same report, Apple also managed to gain market share. So, we have to look at those two stories. And then on the Mac side of things, look, they didn't introduce a new Mac in the quarter. So we had seen the jump from when they had put out the M1 Mac and the M2 Mac. And now, we have an announcement from them from last week of the new MacBook Pro with the M2 Pro and M2 Max chip and the Mac Mini with the new chip as well. But those aren't going to be included in this quarter. They're going for the next quarter. So Q2 would be when those would show up. So I think those are the big things to look at. When they had reported last time, Apple CFO had pointed out the substantial decline in Mac sales. So it's not as though that's something that they weren't expecting. I think the bigger question is obviously on the iPhone and what this means for Apple's health overall. This isn't the first time we will see iPhone sales decline year over year. We've seen it before. As I said, in 2019, we saw it. And the issue there was just the general malaise in the smartphone market. The conversation was about how the market was saturated, nobody wanted to buy smartphones, and then Apple went out and started picking up sales again. So, it doesn't appear as though something like this will last long. Don't forget they're having these tough comparisons to the same time last year, and this is all still from the COVID hangover, as well as that shutdown that we had seen in China. So what it means for the overall health of the company, it's hard really to distinguish at this point.
I mean, a lot to digest there, even before we get into the actual earnings call itself. Great stuff there. Dan Howley there for us. And of course, everyone be sure to watch our special this evening following the Apple earnings call as Brad Smith and Brian Sozzi and our special guest Dan Howley break down the need to knows for the tech giant. That's ahead on Yahoo Finance's After the Call. All right, coming up, love is in the air. We'll chat with the CEO of 1-800-Flowers.com about the delivery outlook for its floral arrangements ahead of what's expected to be one of the highest Valentine's Day spending years on record. Stay tuned. One 1-800-Flowers.com reported an earnings beat before the bell with help from its gourmet foods and gift basket business in the holiday quarter. Well, now it's gearing up for Valentine's deliveries as consumers look to spend an average of nearly $200. That's according to the National Retail Federation. Now, that's much higher than last year's $175. Well, let's get to 1-800-Flowers.com CEO Chris McCann for more on what he's seeing this season. Good to have you here. I mean, we're seeing the stock price certainly coming up roses based on what they saw in that upbeat forward guidance. We knew that margins was going to be a big theme here when it came to earnings. How was 1-800-Flowers able to navigate this?
Well, Rochelle, first off, thanks for having me on. And you're right, it's great to see the stock performing like it is today after our earnings announcement. And I think that's really because people are seeing the long-term position of strength that we as a company are in. So to your question of how are we managing through gross margin, last year with all those inflationary inputs that we all got caught with in the retail industry, especially on the supply chain side, we've been able now to begin to manage through those. So we had told the investment community we would stabilize gross margin this past quarter, and we did better than that. And we look to now start to improve gross margin as we go forward, getting back to our historical highs over the long term.
As we look at some of these bumper events as well, though, how you fared on Cyber Monday, and then, of course, now coming into Valentine's season, are you surprised that consumers are not pulling back on their spending here?
No, Rochelle, what we've been seeing really since holiday of last year is the consumer has started to pull back more and more on the everyday business, the birthdays, the anniversaries. So that's the softness that we see in the market. But the consumer still comes back for the holidays, as they did for this past Christmas holiday season. And we expect the same for Valentine's Day and then going forward into the Mother's Day holiday. And for Valentine's Day, like you said, we're very encouraged by the data put out by National Retail Federation, expecting this to be an important holiday. When you have a holiday like Valentine's Day, we all have people in our lives that are Valentines of one form or another, and we need to reach out and express ourselves to those people. So we're the company that helps you do that.
And it's interesting because we are seeing a lot more gift giving outside of, say, your traditional partner. I know I always get my daughter flowers on Valentine's Day, make her feel a bit special. But you also have, of course, social media, giving people that fear of missing out, people sort of upping the levels when it comes to how they give these gifts, especially around things like Valentine's Day. How has social media played into the success of 1-800-Flowers?
Well, it's just a great way to promote the wonderful products, and not just the products, but the story behind the products. So social media gives us a way to interact with the consumer differently than we have in the past. And as a company, we're really transforming ourselves from a transactional e-commerce company into a relationship company. Our goal is to help our customers build and maintain the important relationships in their lives. And to do that, we have to have a deep relationship with our customers and give our customers a broad breadth of product from 1-800-Flowers and Harry and David and Personalization Wall and all of the other brands that we have, giving you plenty of choice, whatever the Valentine's Day need that you might have may be.
And we did see the National Retail Federation also talking about really more spending on services than anything else when it comes to gift giving. How does 1-800-Flowers navigate that?
Well, we believe that giving is really the gift. And that's why our best customers are those who purchase more often and realize that they take a lot of pride in the ability to give and to make an impact on someone's life. So as we look going forward, a part of it is to make sure we're bringing all different types of products to the table, personalized products. We recently made another acquisition in the personalized product category of a small business called Things Remember, which we'll just plug onto our platform, or experiential marketing programs like floral design classes, charcuterie board design classes from Harry and David, giving our customers different ways of interacting with our brands and products.
And in terms of what you're expecting to be the best-selling trends going into this Valentine's season, what are the standouts for you?
Well, of course, it's Valentine's Day. It's always going to be roses. But then we have different kinds of flowers. Lilies, tulips are very popular, but also very popular this year for us, and actually for the last several years and growing, is Shari's berries and our chocolate-covered berries and the pairings that we have of berries and flowers and berries and wine and berries and cookies and berries and berries. So we take all of these wonderful products from our platform and bundle them together to give you a great option for Valentine's Day.
Now, of course, we know it's a tight job market out there trying to get all these deliveries. Any issues in terms of supply chains or any sort of hiring that you've had to do to ramp up to really get ready for this Valentine's season?
Yeah, we think we're in really good shape. This past Christmas holiday season, we did well on the labor front, and a lot of that was due to better availability of labor for the season and also automation capabilities that we've put in place to reduce the need for labor that we may have in some of our distribution centers. But again, at Valentine's Day, so much of our business is floral related, and really where we work with a network of the best local florists in the country, around the world, to make sure that we get the best quality product for you. So we're in very good shape for this Valentine's Day holiday.
Well, there you go, people. No excuse to not be receiving something. A big thank you there, 1-800-Flowers.com CEO Chris McCann. Thank you so much, and happy Valentine's Day in advance as well. All right, coming up, bottling up the market. Drug makers grapple with patent expiries, post-COVID profits, and more. The analysts' take up next. pharma in focus now. Drug makers out with results as the companies try to explain their strategies in a post-COVID world. Joining us now, Mohit Bansal, Wells Fargo Managing Director of Biopharma Equity, and also with us is Yahoo Finance's Anjali Kemlani. So good to have you with us, Mohit. So we already saw what happened with Pfizer. What about other expectations for potentially some of these other companies as well, who have had their pandemic-related medicines and treatments now forward-looking? What are you expecting in terms of guidance here?
Great. Thank you, Rachel, for having me today. So like we saw with Pfizer as well, COVID is really highly uncertain for this year. More like COVID is probably going to stay here, but the question is, what would be the testing rate, what would be the diagnosis rate, and how many people would actually go and get their COVID pills or vaccines. So because of that, I mean, I think most of the drug makers, I mean, Lilly has basically guided for pretty much no expectations for this year. And Merck has also said only $1 billion in their COVID pill revenues. And Pfizer also brought down the expectations significantly. So overall, COVID is pretty much out of the models. Pfizer is probably the only one in our coverage where it is still a significant part of it because it was their biggest business last year. But for the rest of the companies, it is a smaller business now.
Mohit, Anjali here. I know that Pfizer's a little bit in the rearview mirror right now, but I heard you on the call, and I know that, of the 4 companies we're looking at today, Pfizer is one of the 3 that really has a lot of pressure from COVID. And I've said that they're sort of back at square one compared to where they were in 2019 when Bourla first took over. I mean, looking at what their quarters were, quarter over quarter, absolutely blowout, 80%, really high numbers in terms of operational growth. Now they're looking at their pipeline and trying to figure out how to, number one, combat that loss of exclusivity, as well as sort of tempering expectations for the COVID products. But we do know that there is still demand there. What are you seeing in terms of, what are your expectations in terms of this balance that's now going to be struck between, the continued offsetting of revenue coming in from COVID versus the rest of the pipeline?
Right. So the way, this is a great question. And the way we think about Pfizer, you kind of have to look at Pfizer as like 2 different businesses. They have an ex-COVID business and the COVID business, because COVID is really uncertain here. So for COVID, they had more than $50 billion revenues last year. And that number is coming down to, they guided for 13 billion or so for vaccine, 8 billion or so for Paxlovid. So it's significantly declined. But the question is, how would it look like for a tail? Pfizer thinks that the tail could be bigger in terms of there could be vaccination rates improving and all over time, and the pricing could improve for vaccines. We think it could be a little bit of show me story. We are modeling it to be a $6 billion tail, which is where most of the investors agree with. Pfizer's number could be in double-digit billion dollars or even higher there. So that's where the delta is. But for the rest of the business, I think Pfizer has generated a ton of cash with their COVID business, so they can actually go out and do more deals, which could help them offset some of the core business patent expiries that are coming in 2025 and beyond. So that's how we say it. There is a tail for COVID. The question is how much it is. And then rest of the business, can they offset the LOEs? It is, again, a show me story, and that's the challenge owning Pfizer right now.
And talk to me about Lilly, because I know that diabetes drug, the miss that they got there, but we've also seen the excitement around the potential of it to be used as a weight loss drug. And so I wonder, what are we looking at in terms of this company also coming off of sort of a two company look with the COVID product, the monoclonal antibody, and then the rest of the pipeline. What are your thoughts about this new diabetes drug?
Right. So COVID is a significantly smaller part of Lilly's business versus Pfizer. I mean, I did not even remember that they had a COVID business until you mentioned it. That's how much people don't think about COVID for Lilly. Lilly is a really good growth story. And I mean, today diabetes was a little bit weak, or Mounjaro plus Trulicity was a little bit weak. But I think today's weakness has less to do with the numbers per se, and more to do with some rotation out of biotech and pharma given that you can see the Nasdaq is doing so well. So probably rotation into the tech sector at this point, probably. That's what we are hearing. But again, Lilly is one of the best growth stories in biopharma right now. However, the challenge is that you are paying for it. Multiple is clearly reflecting that. So that's why they really don't have a lot of room to miss. And when they came out a little bit lower on consensus, versus consensus, they came out a little bit lower. It hurt them a little bit more than others, and because this has been a high flyer for a while now. So that's why there is a rotation there. But overall, COVID is probably not. COVID is pretty much going to be zero this year for them, and it is not. And I don't think investors even think about COVID business.
And Mohit, of course, I want to ask you about Merck. You do have an overweight rating for them. What do you like here? Obviously, a lot of disappointment at the moment, but then also looking forward, we know that they're going to be having some new product cycles coming up as well. What is giving you hope, at least for now, for Merck?
Right. So Merck, we like Merck because they have a base business with Keytruda, one of the biggest cancer drugs out there, and it's growing significantly, and it could become a $30 billion plus product by the end of the decade. I think why we like it is because investors in general are concerned about Keytruda losing patent exclusivity in 2028 and beyond, and now onus is on Merck to figure out pipeline so that they can offset that loss. And what we like about Merck is that they are working on it. They have cardiovascular pipeline. They acquired an asset from Acceleron last year, or maybe a year and a half back, and that trial has worked out. They have an oral PCSK9 that can be combined with statins to provide 40-50% incremental cholesterol reduction. So that's a pill. So that could be a decent product. So they have guided that in cardiovascular business they can generate $10 billion revenues. And in oncology, the next generation products, they can generate another $10 billion revenues. So you cannot eliminate, you cannot completely offset Keytruda when it goes off patent, but they are making the Keytruda problem slower. So this will be an evolving story over time, and that's why we like the name.
All right, we do appreciate you joining us with your insights. Mohit Bansal there, Wells Fargo, Managing Director of Biopharma Equity, and Yahoo Finance's Anjali Kemlani. Thank you both. All right, Ford set to report earnings today after the bell, with investors watching that company's fundamentals as it stays locked in that EV price war. Joining us with more is Yahoo Finance's Pras Subramanian. A lot of people wondering about that race to the bottom with prices.
Yeah, Rochelle, big race to the bottom on those prices, definitely for sure. But, mostly what investors will be watching, I think two key parts will be sort of forward guidance there for their EBIT or earnings before income and taxes, so or interest and taxes, sorry. So basically they had guidance of around $11.5 billion for 2022. Are they going to hit that guidance? And also for 2023, what will it be? Investors looking for around $10 billion estimated EBIT guidance there for 2023. But also, margins, right, Rochelle? Those, like you said, the race to the bottom pricing. Ford will probably report around 7% margins. That's what people are looking for 2022. Is that going to come down after they've sort of cut prices on models like the Mach-E just this past week? Are we going to see pressure there as customers sort of are trying to tighten the purse strings? John Lawler, CFO of Ford, said last quarter that he saw customers trading down to lower trim levels to afford the cars that they want. And then also they're actually taking out longer loan term payments to like 72-month term payments to get cheaper payments for their loans. So, we're going to see a lot of that too. And are we going to see incentives coming from Ford to kind of lower some of these high truck margins for those very popular trucks that they offer? Are we going to see those prices come down because of the incentives? So that's probably what we're going to see and trying to hear for on the call and also in the earnings statement.
And Pras, of course, other automakers are shedding jobs. Is this a course correction or sign of deeper worries in the auto industry?
I think it depends. It's a case-by-case sort of basis. So we said GM last night or 2 days ago said that they were not going to cut any jobs. They're going to do some around $2 billion in cost savings through other types of measures. But then we saw Rivian cut, again, 6% of staff, non-manufacturing staff, in order to sort of boost their cash reserves and really plow that money into production and distribution. So it's really coming down to what companies say. Ford also had already mentioned that they're going to cut some white-collar jobs. So we already know that's coming. The question is, will we hear more about not, that I'm not sure yet, but I think they're sort of setting themselves up with a two-pronged attack with their Ford Model E business, which covers the EVs, and the regular Ford Blue Oval, which is going to cover their gas-powered cars. So they're already splitting the business up, and they're also sort of focusing on high-growth areas in their legacy business to fund those high-growth areas.
It'll be fascinating to hear more about that. Subramanian, thank you so much for that update. All right, coming up, we preview what to watch as we prepare for some big earnings reports after the bell. Stick around. So we're finally approaching the big one, the apex of tech results season. Apple, Amazon, and Alphabet all reporting after the bell today. Now, Apple is set for its first revenue decline since 2019, with lingering questions over iPhone demand, the situation in China, and whether or not there will be any hints at layoffs. So far, just hiring freezes. And of course, we'll also be all over Amazon to get a sense of the depth of the digital ad market slowdown, consumer demand, and how the cloud is holding up. Amazon, of course, cutting thousands of positions as it looks to scale back amid a higher rate environment. Also one of our trending tickers at the moment. And finally, Alphabet's numbers will also be watched with laser focus. Its place in the highly competitive cloud market will be key, as well as how Google search is holding up amid a weakening economic backdrop. Also one of our trending tickers, so a lot of interest as we head into those. We're also going to be taking a look at some other earnings here. As you can see, chipmaker Qualcomm, another one to watch in terms of some of the glut that we've been seeing, how they've been faring, how they've been managing their inventory, and all important forward guidance, especially as we look to the auto market. Also taking a look at Starbucks. We know China will be a big part with their reopening story there, and also really getting a gauge on the consumer and how they're feeling about spending a little bit more as they do on Starbucks coffee. And of course, we talked about Ford with our very own Subramanian. A very crowded market now, and also looking at how Ford will be positioning itself with its EV market as it goes up against rival Tesla as well. Well, I also want to do a final check of the markets before we go. We know it was a mixed picture going into the show. Still the case at the moment. We see there the Dow there off about 0.5% there, dragged down by Gilead Health and also by some weakness that we're seeing with Pinduoduo and some of these other Chinese stocks there, down about 0.5% on the day. Taking a look at the S&P 500 there, that's down about 1.33%. And the tech-heavy Nasdaq still rallying there thanks to some boosts there from Meta and a lot of optimism, as we've been speaking about, from analysts who really do see this fiscal discipline that Mark Zuckerberg was talking about, this year of efficiency. They seem to be believing him at the moment. We'll see how that pans out, but at least for now, they're helping boost the Nasdaq. Well, that does it for now. I'm Rochelle Akufa. I'll be back at 11 a.m. Eastern. Don't forget to join us for our 3 p.m. show and, of course, our call after the bell at 6 p.m. We'll see you then.